and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital.
Yeah.
There's nothing closer than the phone in your hand.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Just about squeezed out a second day of gains on the S&P 500 in yesterday's session. This morning, slightly negative on the S&P 500. We are softer by 0.2% on the S&P. On the Nasdaq, we're down by 0.3. A monthly gain, though, in the month of July. Fifth straight month of gains on the S&P 500. That monthly winning streak, the longest going back to 2021. It's been pretty neat. It's been pretty tidy. In the bond market, we look like this: 2-year, 10-year, 30-year. The 2-year yield, 487.25. The monthly move on the 2-year, down about a basis point. I made that one of the smallest monthly moves of the year so far. 2-year barely did a thing, and maybe, Lisa, that's why there's a little bit of enthusiasm returning as well, because you get that stability around rates, and to your point, the Fed starts to back away on top of the data showing some resilience. Good news all round.
And it means that the strategic ambiguity that we've heard from central bankers means stop worrying about them. Don't even think about them, because right now people aren't worried about the tail risk that has been one of the main tail risks of the entire year, which is that the Fed will kill this. Now they're just like, no, I think we're good.
12 months ago, they hated a rally. They were pretty outspoken about it.
Exactly.
12 months later, barely on the radar, it seems.
They're not going to jawbone this rally down, which I find interesting, and people are taking comfort from that. So they're not on the radar as much as they used to be as a potential tail risk, even as you mentioned earlier, credit conditions are tightening at a steady pace, not a break in the credit transmission mechanism. When does that start to matter?
10-year at the moment, just in and around 4%. Let's push it through foreign exchange. Take a look at the euro. Some pretty dreadful data out of Europe over the past week or so. To break a 110 again, 109.73. Euro dollar negative here by 0.2%. Under surveillance this morning, the latest manufacturing data out of China disappointing once again. The Caixin PMI falling to a 6-month low and below the 50 level that marks the difference between expansion and contraction. This follows the official manufacturing PMI that came out earlier this week, also showing a decline in China's factory activity last month. That data out of that country, that economy at the moment, Lisa, cannot get a break.
It cannot get a break, and it's led by manufacturing. It will only get more difficult for China, which is what people are talking about, if commodity prices continue to rise as they have, given the amount that they have to consume. Meanwhile, this big question remains: what's the support going to be like from policy officials? They've pledged support. We haven't gotten that many details. There's been minor rate cuts. There hasn't been some sort of full-fledged recovery trade for the housing market. At what point can they stimulate this economy while still maintaining their goal of reducing leverage?
Or are you pushing on a string? Are we at that point right now where we're starting to see some features of a balance sheet recession start to grip, coming out and making it easier for people to buy new homes? Do they want them? Do they actually want to lever up and buy another property? That's the moment I think we're trying to work out whether we're at in China at the moment. I was going through some of the numbers around the property market. The value of new home sales by the 100 biggest real estate developers in China, down about a third, down 33% or so from a year earlier. That's a problem. You've seen what's happened with developers, both in the debt and equity markets over in China in the past couple of days. We are holding on to this statement from the Politburo from last week, and it was what they didn't say that a lot of people are entertained by. It didn't have the reference to Xi Jinping's mantra that homes are for living in rather than speculation. But are they going to be able to encourage that investment in the market? That remains to be seen.
Especially while continuing to double down on Xi Jinping's goal of trying to move to a middle-class, more consumption-based society and less with the trappings of the previous growth cycle, which really was about inflating housing prices, inflating some of the infrastructure.
That's China. I wanted to talk about this story as well, going into payrolls on Friday. Something we'll be watching. Just more job losses potentially. CVS preparing to cut about 5,000 roles to help reduce costs. This from the Wall Street Journal this morning, reporting that most of the roles will be in corporate positions. The company saying it doesn't expect customer-oriented roles in its stores, pharmacies, and clinics to be affected. So rather like yellow yesterday, Lisa, is this more about CVS and their industry than it is about maybe what's happening in the broader economy?
CVS has been a specific story, and a number of the large drugstore chains have faced some particularly specific headwinds. That said, to me, the trend is middle market, middle office types of workers. The corporate office is the one where there are people getting cut, not necessarily the front lines of consumer-facing employees. To me, this has been the theme that we've seen so far, because it has been a white-collar recession in the labor market, not necessarily a blue-collar one, or people in service sectors. At what point does that start to show up in the data in some sort of more material way if the people in the corporate roles are getting paid more? This has been one of the big questions underpinning this labor market.
Payrolls Friday, just around the corner. The estimate at the moment, about 200K. I promised you we'd talk about this story a little bit earlier, so here it is. Home prices in the UK falling at the fastest rate since 2009. The Nationwide Building Society said prices fell 3.8%, slightly less than the 4% that economists were looking for. But this drop, of course, comes as the Bank of England is set to hike interest rates once again later this week. It's starting to bite, Lisa. More quickly in the UK, of course, because the mortgage market is so different, starting to bite more quickly there versus, say, the United States.
Which raises a question about whether we're not seeing the effects yet in the U.S., whether it's delayed or whether it's postponed indefinitely because of the 30-year locked-in mortgages. Is the UK, in other words, a test case for some of the other areas, the other regions where rates have gone up significantly, but there are lag effects? Or is it something that is more specific because of how some of these mortgages are structured? I don't know the answer to that, but it's something that a lot of people are saying when they say, well, just wait and you'll see that slow down. You'll see prices of homes come down. People are not saying that anymore because there have been all of these offsets. Is the UK a leading indicator that that still holds true eventually? It just will take a while.
Bear in mind, it is taking a while in the UK as well. So if you think about a popular mortgage right now, 2-year fix, mortgage rates above 6%. If you take the effective rate on the average loan of outstanding mortgages right now, it's something close to 3%, up from about 2% when they started hiking. So it's taken a while, even in the UK, but it's happening. And you can see the direction it's moving in. And if the Bank of England stays at these levels, never mind going further, and more mortgages come off and more people have to start taking more financing, that effective rate, that average rate, is going to start creeping higher and higher and higher.
And it couldn't just be this sort of gentle slope upward. There could be a moment, either a catalyst, a forced sale kind of moment, where suddenly those prices come down more quickly and you start to see a more sustained increase in the average mortgage rate. So these are some of the things people are looking at to understand the transmission mechanism of raising rates, which hasn't had the impact that a lot of people were expecting.
We can have that conversation right now with Sarah Hewen, Europe and America's research head over at Standard Chartered Bank. Sarah, wonderful to hear from you, as always, and welcome to the programme. Is it starting to bite in a more material way in the United Kingdom, the transmission from higher interest rates at a central bank into the broader economy?
I think it is starting to bite, but I think we still have to wait for the full impact to be felt. Remember that only about a third of households have mortgages, so you're really targeting a certain part of the consumer market that with these higher interest rates. Obviously, businesses are facing higher rates as well, but so far the data, the spending data from the UK have not been affected as badly as might have been expected given the sustained rise that we've seen. Now, I mean, consumer confidence has fallen, consumer confidence is weak. We're just starting to see the signs of weakness in the labour market, and I think that that's going to be the element that really has to change before we do see these higher interest rates starting to have a material impact on consumer spending in the UK economy.
Jordan Rochester was just on, and he was saying that he thinks the Bank of England is sufficiently restrictive and may not have to hike again, even though we are seeing inflation at a sustained pace, particularly led by the services sectors. What's your belief? I mean, do you think that they are sufficiently restrictive, or that they have no choice but to make inflation their priority in order to restore their credibility?
I think this question about credibility is absolutely key because, of course, they've raised rates quite dramatically over the last 18 months or so, and the impact of that is not fully going to be felt for another 6, 12, 18 months. But in the face of inflation, which is so far away from the inflation target, it's really difficult for policymakers to call a halt at this point. I mean, we're getting hints of that in the US, we're getting hints of that from the European Central Bank as well. But for the Bank of England, inflation is still high, it's coming down, but the difference, I think, is that we're seeing clear wage pressure, potentially a wage price spiral starting to become embedded, and policymakers can't afford to let that get a hold of the economy. We think that they'll raise rates 25 basis points this week, but we'd expect another couple of rate hikes after that in September and November before they can really feel that they've done what's necessary.
Do you believe in the lag effects, or do you think that interest rate rises just are not that effective anymore, given how companies, how consumers have adapted to the expectation that eventually rates would go up and to lock in incredibly low rates for a very long time?
It is different this time around. If we go back to the 1990s, which was when we last had a really dramatic impact on the housing market from higher interest rates, it's a different situation now where many mortgage holders have fixed rates, but it just means that the impact is delayed, and that makes it even tougher for policymakers. As people roll off their fixed rate terms, they have the choice of fixing at a much, much higher rate or taking a punt, going for a variable rate on the hope that rates won't stay high for too long. And I think that the impact is as significant, but it's just spread over a longer time period. So that is, I think, going to become more of a feature of the economy, particularly next year. We think there is a high risk of the economy going into recession around the turn of this year, and certainly into next year. We've got a negative GDP for the year as a whole.
When you take a look at the recession expectations in the U.S., a lot of people are pushing them out and saying they're not going to happen. In Europe, people are already seeing it in Germany. Are you getting more discouraged by the expectation in Europe right now, just based on what we're seeing from Germany, but also the economic surprises that have come in disappointing again and again versus the upside surprises in the U.S.?
Yeah, I mean, in Europe, the survey data.
Then we lost the connection there with Sarah Hewen of Standard Chartered. There's a theme this morning.
It's just we stop people in their tracks.
Things aren't breaking in the market, though. That's been the theme so far. Hopefully we'll work out what's going on. We'll catch up with Guy Labas of Jenny Montgomery Scott. Guy, if you're listening, hopefully we can talk about fixed income around 7:30 Eastern time without your connection breaking. We've got some earnings for you breaking across the terminal. Let's share them. Caterpillar beat on the top and bottom line. Caterpillar second quarter EPS 5.55, the estimate 4.54. Revenue for the second quarter 17.32 billion, the estimate 16.39. A beat, an upside surprise, an upside surprise. Then this, the outlook for the third quarter. Sales and revenue to be lower than the second quarter. The year's adjusted operating margin will be close to the top end of the range. So there's a beat here, but I wouldn't say there's a raise, that's for sure. We're down about 0.75% on Caterpillar in the pre-market, Lisa. Basically, they're warning that you're going to get a slowdown in the third quarter. The second quarter, though, I think we've got to talk about where we have been before we talk about where we're going. It's defied expectations of a slowdown in a big way.
We haven't seen the recession get as deep as many people thought in some of the agricultural areas and some of the areas that Caterpillar really does specialize in. If you think about construction and how much home builders have actually been active, if you think about a lot of the farming products, a lot of the aspects that Caterpillar caters to. Going forward, though, and this is important, at what point do you see that steam roll over just as other areas of weakness come into play, which is the reason why you're not seeing a bigger gain buy some of those shares.
One pocket of the market that you know has done tremendously well so far year to date has been the airlines. Discretionary spending has been robust, resilient, and anyone living at an airport at the moment, going through one, stuck in one for a long time. I think we've all been there. This isn't a complaint. It was about to be one. But I think you've got a decent idea that things are really, really good right now for the airlines in America. So in line for an airline is basically a miss at the moment. And what you get from JetBlue is in line. Second quarter EPS, 45 cents, the estimate 44. Revenue for the second quarter, 2.61 billion, the estimate 2.61 billion. So the analysts seem to have done a good job this morning. They still see demand as being robust and healthy, using all the right words, Lisa, but the stock's getting hammered, down 7%.
I don't understand this. I've been looking for why, and I don't understand it. They say we remain on track to deliver a profitable year, record revenue performance. Where's the negative here?
Give me more. We want a beat and a raise, Bremo.
Is that really what this is?
In America.
Is that really what this is? Is that how high the bar is at this point?
No idea. Let's see how this stock evolves through the morning. We're down about 7% right now. From New York City, good morning.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
The names that move markets are on Bloomberg.
Concentration in industry after industry after industry is a threat to our economy. It is a threat to innovation and ultimately often leads to price gouging, whether it's consumers or the government. I believe in the power of markets, but they only work if we enforce the rules that keep competitors going rather than monopolists.
Nobody covers business like Bloomberg, your global business authority.
DOJ or other authorities
Could face bigger challenges next.
It was going to keep rain World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
We're seeing very strong gasoline and very strong jet fuel demand. People are traveling, people are spending on services. And then on the diesel end of the spectrum, we see that as being weaker than people had expected. China is still growing. It's grown 3% in the first half of this year, obviously well short of what people would expect from China, 5 to 6%.
That's the unknown for the back half of this year. The kind of stimulus we get out of China, whether it bites and can deliver a little bit more of a lift to that economy in the second half of 2023. Disappointing, a move to the downside in a way that wasn't anticipated 6, 7, 8 months ago when we started talking about the reopening. That was the BP CEO, by the way. Your S&P 500 futures look like this morning, negative on the S&P, down by about 0.2%. Yields a little bit higher by a single basis point, 396.89. And in the commodity market, crude just a lift over the last month, a stellar month of gains for crude, Lisa. WTI this morning, $81. We're down there by 0.6%.
We just had the biggest monthly gain going back to January of 2022 at a time when a lot of people are saying if oil prices remain stable or remain about here, that'll be fine. But we heard Jordan Rochester earlier say they go to 90, they go to 100. It could cause central banks to rethink their rate hiking cycle and actually raise rates again.
Do they want to chase the crude price?
You've asked this before. I was thinking about that. You were saying, are they basically just looking to raise rates to fight oil prices?
I've always struggled with that.
But how much of a...
We used to joke back in the central bank activism days, and you and I think probably talked about this a few times, that they shouldn't have been buying bonds. They should have just bought barrels of oil.
They did.
You know,
the strategic petroleum.
No, I mean the central banks.
No,
but,
I'm
you know,
kidding.
if they really wanted to get inflation up, and that's what they cared about, just sort of prices for the sake of higher prices, then they could have done that.
There is a question about how much lower oil prices has underpinned the decline, the sort of macula disinflation that we've been seeing in certain areas of the market, just because of the bleed through in pricing across the board of higher oil prices or lower prices. I'm thinking airlines, I'm thinking even shipping things. So if that starts to tick up again, how much does that influence the entirety of the inflation picture in a broader way than just simply the energy price input?
When it comes to consumer expectations, there's one price that shapes things almost exclusively. And my favorite indicator that you get from the University of Michigan with inflation expectations, I think there's a strong lead there that crude and gasoline prices shape that almost exclusively, don't they?
I think that if you chart the price of gasoline, and you chart the expectations for inflation for the University of Michigan survey, there's a...
You notice that I'm calling it my favorite read now, because I'm hoping they call me one day.
You've already told them you're going to give them some sort of crazy number. Of course they're not going to call you.
Let's see if I get a phone call. Great story yesterday from our colleagues here at Bloomberg News that according to people familiar with the matter, Exxon is in talks with Tesla, Ford and VW and other automakers about supplying them with lithium. Kevin Tynan joins us now, senior automobiles analyst at Bloomberg Intelligence. Kevin, can we start with that story? An oil producer going in more into the lithium business and supplying these auto manufacturers. What's this look like going forward?
Well, this is what we've been for 5+ years. You say electric vehicle things and hope it gets you the valuation. We're still a long way from, mining that lithium, getting it to the manufacturers, building that supply chain. So, yeah, I mean, I think there's a group of suppliers, even in auto parts, that are, anything from all in on electrification to trying to figure out how they're relevant in the future, to technology agnostic, meaning it doesn't matter what the drivetrain is, tires, glass, seats, things like that. So I think you have this bucket of suppliers that are trying to figure out how to be relevant in the next iteration of the auto industry.
Kevin, how disconnected are things between the goals of governments across Europe and the United States and the infrastructure that currently exists?
Yeah, look, I think there's a lot of issues in terms of, when a lot of times we just hear about tailpipe versus no tailpipe, and I try and go back to shovel in the ground to disposal of a battery at the end and really think about the entire value chain the whole way. So, look, the infrastructure is certainly an issue, but I think there's a lot more too in terms of back from where the materials are coming from, where they're processed, what they cost, the value of them relative to the internal combustion technology that already exists. And the issue is really getting to profit parity between the two technologies, not necessarily the price parity, because if you have one technology that's significantly more profitable than the other, which right now is internal combustion, the automakers are going to focus on that and do more than that and drive their profitability with that technology, not the unprofitable one. And that's why this transition's a little bit messy, especially here in the US, where we have a little bit less subsidies to the manufacturer or penalties to the manufacturer driving consumer demand.
Well, do consumers really want electric vehicles as much as people previously thought? And I ask this after Ford moved away from some of their high projections of how many electric vehicles they'd have on the road.
Yeah, and I'll tell you, Lisa, I've been saying this for years. It doesn't really matter what the consumer wants or doesn't want. If it's not profitable to an automaker, they're just not going to build it. And unless there's a penalty for not doing it or there's a subsidy that makes you whole on your income statement, you're going to move at the pace of profitability, or you're going to go where the profitability is. So I think there's a little bit too much put to what the consumer wants versus what the manufacturer wants, because dealers can't sell what they don't get from the manufacturers. Consumers can't buy what the dealers don't have. and left to its own devices, which is profitability right now, you're going to get a very slow movement, slower here in the U.S. than you do in Europe, where the penalties are more significant, or in China, where the subsidies are much more significant. And that's just the way this market's played out over the past couple of years.
Is the physicality of electric vehicles truly that much more efficient than combustible engines, given the fact that it is so much more complicated to mine the lithium, to get things to the floor? It's expensive, it's complicated, and it entails a lot of materials. Is it more efficient?
Yeah, and you know what? That's a question I think we need to be asking more. I don't have an answer, but anytime you bring up the two sides of that argument, you know, one side science is right and the other side is wrong, and you get both sides saying the same thing, which is our science proves this, our science proves that, and yours is wrong. And I agree. You know, like I said, I want to go from shovel to disposal and understand how much better this really is. And I think if you come to that conclusion that the net benefit is there but not as significant as is priced into the market, then this just becomes about capitalism, not climate.
Kevin, just a final question. The demand for this stuff, what does it look like at the moment? We've seen price cuts from Tesla, from Ford. What is the demand for EVs at the moment?
Yeah, look, this is the cyclicality of the market, right? And when you get to a point where you're saturated in terms of market share, this is what happens. You build or have too much capacity, build too many things, have to figure out how to sell them. And keep in mind, too, the difference with Tesla, Rivian, Lucid is that they don't have a franchise dealer network. So they're not collecting that revenue, right? They're booking that cost of goods on the build of the vehicle, but they're not collecting that revenue or booking that revenue until it's delivered to the consumer. Where a franchise dealer base, it's a working capital management, but you know, those manufacturers are booking that revenue on the sale to the dealership. So when you look at Rivian or Lucid specifically, who's delivering about 60% of their output, you have this inflated cost of goods and a very low revenue per unit, and it makes you unprofitable at the gross line. So that's where you get price cuts, right? You have to keep the production moving. You have to get product in the hands of consumers. And when that backs up because of macro environment, this is what you get. You get the auto industry looking like the auto industry has looked like for 100 years.
Hey, Kevin, thank you. Kevin Tynan there of Bloomberg Intelligence on EVs and the auto manufacturers in the United States. In the next hour on Bloomberg TV and on Bloomberg Radio, we'll catch up with Elise Ossenbar of JP Morgan Global Wealth Management. We'll talk to her about the equity market. And we'll talk about this, too, with Anne-Marie down in Washington, D.C. A declaration of economic independence from the governor of Florida, Ron DeSantis. We win, they lose. We need to talk about who the they actually are, Lisa. We win, they lose. A declaration of economic independence and a little bit of an echo from what we heard from the former president, Donald Trump, back in 2016. So that's the politics. And on the market, upgrades from Citi on the S&P 500, looking for 5,000 on the S&P by the middle of next year. We're on record high watch. And then you've got the likes of John Stolfus over at Oppenheimer saying we can hit that record high before the year is out.
4,900 with basically a 20% gain for 2023, which was supposed to be a terrible year.
Plenty of earnings in the mix as well. Yeah. Second quarter for Uber just dropped. 9.23 billion, the number, the estimate 9.34. More on that in just a moment. Your equity market negative here, trying to recover. We're softer by 0.16% on the S&P 500. Yields essentially unchanged on a 10-year, 396.69. This is Bloomberg.
Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
A cruise ship is much more than a flotilla of financials and numbers. Naftali Holt showed me around the Celebrity Beyond, Royal Caribbean's newest ship, rolling out not the red carpet, instead the magic carpet, an example of investment that's yielding returns in several different ways.
Originally, actually, we designed it because we wanted to have a really nice platform for tendering, because sometimes we can't home port
So
destinations.
functional.
Exactly, value fractional. And then we looked at it and said, why don't we just make it a really cool feature spot where people can enjoy it beyond the functional space? And we created this bar. It went up and down.
Now, what does it take to
How
do?
about the Instagram? Can you speak about that?
I can imagine.
Instagram moment with the sunset, having a drink with your friends or family. I mean, that's amazing.
So what does it take to do something like this? And I'm thinking cost, engineering, time.
Yeah, a lot of effort from a lot of people. So it starts from just the design and the conceptual aspect of it. Then we need to figure out a lot of technical factors, the weight, the wind, and so lots and lots of hours of really hard work. And every time we up the game, we see that customer willing to spend more.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders.
Watch Wednesdays on Bloomberg Television.
On the next episode of The Circuit.
I was like, this is a way to change culture. Like, what a different world. Of course, we know for girls, it means so much to have female athletes to look up to, but for boys, to look up to women also, it's really for everyone.
Watch The Circuit with Emily Chang, Thursdays, 10 p.m. Eastern on Bloomberg Television, or 8 p.m. Eastern on Bloomberg.com or the Bloomberg app on connected TVs.
They're ignoring parts of the data that may be pointing to a more significant deceleration.
The market is broadening. It's moving into other more value-oriented parts of the market.
I mean, the big tech has clearly done a lot of impressive lifting here.
I do think the market's a few points overvalued.
I do think our prospects are good long run.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. Your equity market on the S&P 500 trying to recover. Still slightly negative on the S&P by 0.15% on equity futures. Going into the opening bout, a lot to chew on, including upgrades on the equity market from Citi and from Oppenheimer as well, and some economic data out of China. And once again, guess what? Disappointing, Lisa. Downside surprises across the board out of China recently, and manufacturing in contraction territory. Even if there are subtle beats here and there, it's moving in the wrong direction.
Let's just put this into context. Coming into this year, the biggest potential positive risk to markets, upside risk to markets, was a reopening of the Chinese economy, a reacceleration, fueling growth all around. What have we gotten? The economy in the U.S. has been better than expected. The economy in Europe, better than expected. China came back online, it reopened, and oh yeah, are they heading toward deflation? Are they looking at a lost decade akin to what had happened to Japan due to structural shifts? A massive narrative change.
U.S. dominance, both in the equity market and in the economy. The U.S. economy has been far more resilient than people thought it would be. Going into payrolls on Friday, this is what we're looking for. Think about this. On Friday, 200K is the median estimate in our survey right now for the headline number. 3.5% unemployment. In and around is once again the estimate in our survey. Think about where we were 12 months ago. Predictions for where this labour market would be, they were talking 4, 5. Could this economy stand up to interest rates of 5.5%? And here's the Federal Reserve flirting with maybe going once or twice again.
And we're not necessarily seeing the weakness. Maybe we will today at the job openings data that we get at 10. But people are looking at help wanted signs all over. I see them still, particularly in service sectors. Even companies that are trying to cut back aren't cutting. employees because they are so scarred by what happened during the pandemic. They don't want to have a dearth of employees during the recovery. So at what point can you say, yes, inflation could keep coming down, even without that pain that Jay Powell talked about last year at Jackson Hole, without that pain in the labor market in any sort of meaningful way?
Is that where Tom is today, interviewing?
At what? An ice cream parlor?
Where did you see the help wanted signs?
All over. Going on vacation. That's where you see all the help wanted signs, because everybody's going on vacation because that's what you do, and that's why we see these gains.
What you do in the summer. Gets hot and you go on vacation.
Maybe, yeah, exactly.
Right.
Let's move on.
Maybe TK is on vacation. He always does this to me every time I take off.
Yeah, well, he
gives me hell when I'm away, and actually discloses where I actually am.
Yeah, well, it's true.
Which I don't appreciate.
Well,
he names the place.
Yeah,
He's this far away from naming the hotel.
I get people coming up to me saying, "Were you really on a cruise in Norway looking at fjords?"
So I actually thought you were in Norway on a cruise.
Well, that's what he told everybody. So people were like, "How is Norway?" And I was like, "I was not in Norway." "How is a cruise?" "I was not on a cruise."
You were in Alaska.
I was in Alaska,
not on a boat.
But not. I did take one day.
You took a boat. Oh, so
and we saw
you did kind of
whales
cruise
and stuff like that. But it wasn't a cruise. It was like a 6-hour.
Like a boat tour.
Okay, it's not a cruise.
It was a boat tour.
It's a boat.
What was the average age of the people on the boat?
It was all over the place. It was not. What did you think?
Well, no, just that if it's a cruise, usually that average is
much higher.
Much higher.
No, there were families. There were people our age. It was all everything. Yeah.
Okay, just checking. Equities right now on the S&P 500.
I really wanted to know.
0.1%. Just trying to figure out. I think if the average age is like 70 plus, it's a cruise. You're on a cruise. If you're on a boat and that's the average age, you're on a cruise.
Okay,
all right.
That is
in the bond market, your 10-year 396.69 yields higher, Lisa, by a single basis point.
Totally disagree with that definition. 10 a.m. though is the economic data that we're looking for. U.S. JOLTS data, the job openings expected to come down just a touch. Unclear how much this is really going to influence people's views. ISM manufacturing data comes out at the same time. Do we see the ongoing manufacturing recession in the U.S. akin to what we saw in Europe earlier today and China, or do we start to see a bit of a rebound? 10 a.m. Fed speak, including Chicago Fed President Austin Goolsbee. Yesterday, he was talking to Yahoo Finance, and as John mentioned, he didn't commit to raising rates in September, but seemed like he might even entertain it, even though he is dovish. But to me, I thought it was interesting that he sounded like he was calling victory, saying a soft landing is this golden path that would be a triumph, and it's certainly a possibility at this point. So do we start to hear this kind of tone from increasing number of Fed officials?
I mentioned this in the last hour. If one of the biggest doves on the committee doesn't know what to do in September, and one of the biggest hawks on the governing council at the ECB doesn't know what to do in September, it does speak to the kind of moment we're at right now. Zero guidance from anyone on anything.
That, I think, is the only takeaway you can get from this, because right now I'm not going to necessarily say he isn't decided. My guess is he's probably leaning against raising rates in September. That is what his rhetoric is saying. But he's not going to give any guidance because he doesn't have to. They're not trying to job on the market into anything, which has been really interesting. The earnings today continue with a lot of consumer-heavy brands, including Uber, which just came out, Marriott, JetBlue, all before the market, and Norwegian Cruise Lines. We'll ask them what their average age is. I'm sure that it is not 70, especially if it's Disney Cruise. Caesars Entertainment and Starbucks after the bell. Just to give you a sense of Uber, and Marriott did just drop, beating expectations. Shocker, given the fact that everyone's on vacation. Second quarter revenue, $6.08 billion versus a $6.02 billion estimate. Uber coming in just shy of expectations, dragged down by its freight service. Revenue declining. Why? Because people aren't shipping as much stuff. They're not ordering as much and they're not sending as much stuff. So I'm looking at for stuff like this, and costs are going up to get drivers back. And that's maybe why your costs are going up, Jonathan.
I was distracted. The average age of a cruise passenger is 47 years old, apparently.
Oof.
High
Boom.
40s. Didn't know that.
Well, there you go.
Didn't know that.
Would you like to?
Nope. Lisa Ossenbad joins us now, investment strategist at JP Morgan Global Wealth. Don't listen to me about cruises. The stocks are doing great. Elise, it's good to see you.
Great to see you.
Vibe shift. Let's talk about the vibe shift. We're not talking about recessions. What are we talking about?
Look, we concede at this point that we came into this year probably too pessimistic on the macro front. What we're seeing is this resurgence, or rather perseverance, of the resilience in the U.S. economic backdrop. And I think that's been driven by a handful of different dynamics, but it seems like a lot of people are kind of coming around, facing the music, and trying to figure out where we go from here.
Equity market rallies usually do that. People start to jump on board, and now they're thinking about where else they need to be, what's missed out, what's lagged, and they're shifting towards the cyclicals. Banks had a great month in July. Do you see reason for that to continue?
We do, actually. So I think it's really important to think about the anatomy of the year-to-date equity market rally. Everyone at this point knows that it has been predominantly driven by the mega cap complex that, kind of has been flying on the wings of artificial intelligence hopes, but we do think that this rally can start to broaden out. And that's a big reason why we've been encouraging investors to focus on the other 493 names in the S&P 500, which taken together are actually still trading at a valuation below their 10-year average.
What money are they going to use to buy these stocks? In other words, do you start to recommend that people take money out of money markets and put them into, the other sectors of the equity markets? Or are you saying to people that you have to have a balance? I mean, how does this sort of come to fore if you don't want people to necessarily cash out of big tech?
Look, cash is a great place to start. We know that a lot of our clients are still heavily overweight excess cash based on the anonymized client data that we look through for our mid-year outlook exercise. So even in light of this shift in our macro view that the Fed could possibly pull off a soft landing, we do still think that reinvestment risk is here. Come first quarter of next year, we think the Fed could be in a place to start gradually cutting interest rates, and we would much prefer that investors take that excess cash, extend duration, or start rebuilding that equity portfolio that they want to carry through the next cycle.
Does it bother you that you're looking at earnings yields on the S&P 500 that are the lowest relative to what you're getting on a 10-year treasury going back to 2001? Does that raise some alarm bells that maybe valuations are out of whack and that bonds look better than some people are making them out?
Look, we continue to love core bonds. It's one of our highest conviction ideas, and it does bother me a little bit, but we certainly take it into account when we think through portfolio construction. I think investors more than ever need to be mindful of a goals-based or outcome-oriented approach, and if that means then that choosing core fixed income with yields at these current elevated levels is enough to get you to your long-term goals, then by all means. But long-term, 10-year plus time horizon, we still see the potential for stocks to act as that engine of capital appreciation in portfolios, so we don't want to sleep on the opportunity.
We started this conversation by talking about resilience, and about 4 minutes into it, you were talking about rate cuts. What are the factors behind resilience of the year so far that you think are going to fade sufficiently enough that the Fed's cutting rates in early 2024? Can you identify the factors first and then just walk us through where you're seeing signs of weakness that you think will continue coming through that eventually are going to lead this Fed to cut rates?
Sure. So in terms of what's been driving the resilience, start first with the consumer. I think excess savings perhaps weren't drawn down as quickly as everyone thought they might have been, but we do see that kind of tapering to an end over the course of this year. You also have to consider that businesses and consumers both have been relatively insulated from interest rate pressures, given that they locked in lower levels of financing. And you've got these tailwinds coming from the fiscal spending front related to the, more than $2 trillion worth of infrastructure investment that's kind of, earmarked to be doled out over the course of the next 10 years. So those are the reasons for resilience. And you add to that what we've been seeing in the labor market, which is pretty favorable trends when it comes to labor force participation. But to the extent that growth continues to slow, and we are still calling for, flat to slightly negative growth in the first and second quarters of next year, maybe you do see a modest rise in the unemployment rate. And that, I think, continues to urge investors to heed some caution and not get too over their skis when it comes to adding risk.
How much does that really hinge on oil prices staying where they are and inflation continuing to steadily come down?
Look, I think oil prices are definitely kind of one of the, variables or X factors here. We'll be curious to see if prices do continue to consolidate higher. We're doing the work right now on our oil price outlook, but that could potentially change the outlook for the Fed. And we know, just looking at the past year of data, right? A year ago when oil prices had exploded higher, that's when you had consumer confidence hitting all-time lows. And so to the extent that we see that kind of rear its ugly head again, it could potentially weigh on the outlook and, bring a resurgence of bearish sentiment.
Brent Crude, 85. Elise, this was great. Thanks for joining us and thanks for coming in.
Of course. Thank you, guys.
Elise Ossenbaugh there of JP Morgan Global Wealth Management. This from Capital Economics just yesterday on credit conditions following the Senior Loan Officer Opinion Survey here in America, basically a survey of credit conditions to the broader economy. Despite the optimism surrounding the real economy's performance over the first half of this year, here's the punchline. Credit conditions have historically only ever been this tight during or in the run-up to recessions.
A lot of people are pointing out that this is the case. You have to say this time is different if we're not going to get a recession based on the level of credit tightening that we've gotten. Every time out of the 4 times since 1990 that this index was put into place that you saw credit conditions tighten to this extent, every single time there was a recession.
That's the call right now. It's been the call for most of this year. If you are just joining the program, welcome to the program. On the S&P 500, we are negative here by 0.14%. Elsewhere in the bond market, yields are a little bit higher at 397.49. Tons of economic data through this morning, Lisa, going into payrolls on Friday. ISM manufacturing, worth a look. Deep into contractionary territory, sub 50. And I guess the conversation is going to be around whether China can really get things going and deliver a move worldwide, because manufacturing at the moment across Europe as well, it's pretty terrible.
And we've been talking about what happens with the fact that we've seen a manufacturing recession and a services expansion. Which meets which? Does manufacturing start to recover and meet the services momentum, or do we see services come down and meet the manufacturing? What we've seen is a little bit of softening in the services, and we will get that later this week. But manufacturing still deep in contraction at a time when people are saying, well, start to recover already. Come on, let's go. We should be getting to the next part of the cycle. And so I wonder how long you can get this sort of dissonance.
That convergence. Mislav Matejka at JP Morgan has called for a while that he thinks that ultimately services come down to manufacturing. But we'll see. We'll see. Manufacturing data in the US, I think, has improved more recently.
What we saw from Caterpillar right there in the second quarter.
Define expectations.
And how much does the housing market really underpin this? Because you've seen the home builders really get in there and try to build a lot more supply. And that's been sort of the sleeper surprise of the year as well.
The housing market in America is just weird.
It is, right?
The whole thing's just weird.
Is that that's your professional assessment?
That's my professional assessment of the housing market in America.
I felt a vibe shift from you.
Weird. That's my vibe shift
I think
around
I think a lot of people would agree. It's been unexpected. I think that's the word that
if you're in
expect.
it and you own, it's fantastic, and you have that 3%. That's the dream. I talk about it all the time. Just go back in time, maybe a year ago.
How do you feel about that?
I'm just lining up outside First Republic. I go inside and get a jumbo mortgage.
They pay you to buy a home?
Oh, 2% mortgage, something like that. That's the dream, isn't it?
Is it?
Yeah.
That's what you dream about?
Then I take all that money and park it in a cash savings account.
Connection lost. City. From London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Today, PJT Partners CEO, founder, and chairman Paul Taubman sits down with Bloomberg's Shonali Basak for an exclusive deep dive into the state of business. Tune in live at 10:45 a.m. Eastern, only on Bloomberg, your global business authority.
Economic policy needs to be focused on making the cost of living more affordable and the American dream more attainable for American working families. And if you don't get that right, you cannot be successful as a country. And we cannot allow no longer the failed ruling class in this nation to dictate our nation's policies.
The Republican presidential candidate Ron DeSantis of Florida speaking at a campaign event in New Hampshire in the last 24 hours, a declaration of economic independence, some echoes perhaps of what we heard all those years ago in 2016 in the run-up to that election from the former president, Donald Trump. What is intriguing about this shift, though, if he stays here, Lisa, is polling. Polling Republicans right now, potential voters, the number one issue is the economy. Social issues are up there, but nowhere near to how high the economy polls. And you wonder if we hear less about woke and a little bit more about this kind of stuff from this candidate.
I don't know, though, if the economy issues that the population is worried about are the same that Ron DeSantis is talking about, given his emphasis on China and decoupling from China and saying that we need to take back control of our economy from China. Because if that ignites more inflation, people might not be as much on board. In other words, how do you sort of tie in some of the focus on economy with some of the goals in this particular economic plan?
Pretty strong language. America is in a state of decline, militarily, culturally, and economically. People across our nation are collapsing under an economy that no longer works for the American family. Doesn't that just sound like candidate Donald Trump back in 2016?
Populist themes. That's
right?
Basically what you're hearing. And this has to do with even reducing student loan debts. Well, how does that pair with some of the calls against what we heard from President Biden? All of these issues, though, speak to a similar tone in this election cycle that we heard back in 2020 in terms of very populist and coming out and trying to cater to the moment of the issue, which is still the economy.
Let's get down to AMH. Anne-Marie, Bloomberg's very own chief Washington correspondent. Anne-Marie, can we start there? This didn't go unnoticed by the former president, did it?
No, certainly not. He now calls it, as he calls Ron DeSanctimony economics. So he's trying to needle Ron DeSantis. And you can see why, Jonathan, when you look in the polls. While Trump has this overwhelming support, you look at the CNN New York Times, a national poll that was released yesterday. Yes, Trump has this overwhelming support, but the number two at the moment is Ron DeSantis, the governor of Florida. What every candidate wants to do on the Republican field is to get to that number two spot, because the hope amongst many of them is that if you can get to that number two spot, individuals further down the line will start to drop out and throw their support towards you. So Trump understands this, and that is why he's throwing a lot of shade at the governor. But you really hit the nail on the head, Jonathan, when you say this is also about a shift away from the woke policies we've been hearing from the current governor, and more about economic plan overall, tackling China. What do you say about taxes? It's very much so Republican talking points with a bit of populism as well.
You've been following the money. Where's the money going? To which campaign?
Well, at the moment, a lot of donors are on the sidelines. You do see some donors, like one of the Koch brothers, putting money towards going and ad campaigns about not electing the former President Trump, but about where the money is going at this moment. A lot of money is just waiting on the sidelines, and I think you'll see an influx of money come through after the debate. A lot of big donors want to see how these individuals are on the debate stage, and if it moves the needle in the polls. We can also point to the fact that where the money is going for the former president, he still maintains a huge lead when it comes to those single individual low capital donations, $20, $30, $50. Interesting about the Trump campaign is that a lot of that money, actually the bulk of it, $60 million worth, is going to his legal fees $40 million worth is going to his legal fees and the fees of his associates. And potentially that is going to become much harder as he faces a third indictment, which we could see as soon as today or later this week.
You know, I keep thinking about some of these polls and things like the economy or democracy are huge polling issues. And I have no idea what they mean or exactly what, aspect people are pulling out. For example, with the economy, John, when you take a look at that, are people talking about inflation? Are people talking about China? Are people talking about what's going on with woke corporations, right? That's one of the big issues.
Well, when it comes to democracy, both sides think the other side is a threat to it.
And that's the same thing for the economy, right? Because both sides want their ideology represented. But Anne-Marie, when people are talking about that, what is it? Is it inflation? Is it fighting woke ideology in corporations, which is one aspect of this New York Times poll with respect to Republicans, or is it China?
When you look at why Republicans want to talk about woke ideology creeping into the business world, this is more actually a social issue, I would say, than an economic issue. When you look at these polls, inflation has remained top of mind of American voters. Yes, inflation is starting to cool, but it is still at that higher base level. And this is what a lot of Americans have been struggling with. So when you look at the rematch between, also a potential rematch between Biden and Trump, what the New York Times Siena poll shows is that also a lot of individuals are starting to have concerns over, as well as what Biden is doing with the economy, and the biggest aspect of that is because of higher inflation. So yes, there's been wage growth, but it's eclipsed what's going on because of higher inflation. But again, we are still early days. It is still the summer of 2023, and we have till November of 2024. So the economic impact on voters could change, and a lot of voters do vote with their pocketbooks. So we really need to look at what does the economy say next summer and next fall, and I think that will start to dictate where people are leaning.
It also raises questions about the Fed's independence. Ron DeSantis talking about replacing Fed Chair Jay Powell. Not sure whether he thinks that he's not raising rates enough or he's raised them too far. How is that going to factor in terms of whether politicians want to fight inflation or want to support job growth and want to support momentum?
Well, what Ron DeSantis was talking about yesterday is that he doesn't like to see a politicized Fed. What's interesting is because Jay Powell was, of course, appointed by the Trump administration, a Republican, and then kept in the job by a Democrat, currently Joe Biden. But he was talking about he wants to see a Fed that has a strong approach when it comes to maintaining a stable, strong U.S. dollar. So he likely would want to maybe get rid of Jerome Powell. Didn't say it so directly, but the nod was there. These kind of questions are going to become incredibly more important towards the debate stage as well. And these are the kind of issues that, again, the donor class wants to hear about. And at the moment, a lot of the big money is waiting on the sidelines. And I think that's why you're starting to see individuals really start to talk about that. Former Governor Chris Christie talked about that with us here. He thinks he didn't like some of the things Jay Powell did, but is starting to turn it around, would reconsider him. These are the type of questions and the answers that donors want to hear from.
August 23rd, the big debate over in Milwaukee, about a month away. Anne-Marie, thank you. About 3 or 4 weeks away, actually, now. And that debate falls right slap bang in between Jackson Hole and the Fed get-together, the annual symposium, as it's called, 24th to the 26th of August. So it would be quite entertaining if you had Republican candidates for the presidency all complaining about the Federal Reserve on a stage, and then right bang in the middle of that symposium over in Wyoming.
They're going to come out and give you some sense of what they're not going to talk about, which is pretty much anything. I mean, basically, that's what they're going to say is, look around. Things look pretty good.
It's so much easier on the outside to bash the economy and the Federal Reserve when you're not in power. And then you get in power and you need looser, easier policy to juice the economy. And then what are you calling for? It's so much easier when you're outside calling for tighter budget deficits, and then you get into power, and what you want to do, you have the urge to spend. Whether you can keep those convictions from being on the outside to when you acquire power, that's the real test. And from what I've seen time after time, people have failed that test.
I would agree with that, and that's one reason why people want an independent Federal Reserve, want an independent Bank of England, want an independent ECB, because if you are influenced by those conflicting real-time indicators and desires for growth or employment or other things, then you're not going to end up with a stable currency, and you'll end up with a situation that looks more like Erdogan's Turkey.
The criticism of Powell, though, is a valid one when it comes to coming out of the pandemic. They want inequality to be addressed by fiscal policy, not by monetary policy. And there were some not so subtle hints that the chairman of the Federal Reserve was interested in doing some of that.
There were also issues of his re-election and not making a decision soon enough.
And also juicing inequality himself by the policies that we've seen. From New York, this is Bloomberg.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
3 prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
Equities on the S&P 500, slightly softer. We're down 0.25%. On the Nasdaq, we're down 0.4%. To get you set up for the week ahead on Thursday, earnings from Apple, earnings from Amazon. We're down on the Russell by 0.2%. The Russell is where the outperformance has been on the month last month. Through July, the Russell up 6%. The banks on the S&P 500, rip-roaring rally, up 10% on the S&P 500 Banks Index. Quite phenomenal stuff in the equity market as we start to think about maybe a shift in performance away from the dominance of big cap tech to the laggards, maybe. The financials, can that continue? Elise Ossenbar of JP Morgan Wealth Management with us about 30 minutes ago, suggesting it can. In the bond market, 2-year, 10-year, 30-year. Let's slice up the yield curve. It looks like this, unchanged on a 2-year right now, 487.67 on a 10-year yield, up a couple of basis points to 398. Lots of economic data a little bit later. Look out for the ISM manufacturing read, jolts, job openings, looking for that to pull back to something like 9.6 million, Lisa. Is that right?
That's the belief. I do want to say that Andrew Hollenhorst of Citi just published on the manufacturing ISM and saying that it has stabilized and could move back into expansion in coming months. He just publishing this moments ago. So this question around whether you see strength and actually the convergence of services and manufacturing, with manufacturing coming up to services, sort of defying recession expectations.
When would that leave this bond market?
Exactly.
Oh, that could shake things up.
In a significant way, especially at a time when people have kind of shrugged off the risk, the tail risk of a Fed really raising rates further and then really building in the cuts that they're expecting next year.
Unbelievable. Let's finish on foreign exchange. The euro looks a little something like this against the dollar. Break of 110, 109.77. We're negative here by 0.2%. ECB officials in the last week not committing to anything from September. I think Lagarde over the weekend was speaking to Le Figaro, a newspaper, a media outlook over in Europe, and gave us absolutely nothing, Lisa. We might hike, we might pause, but if we pause, it might not be a pause for as long as you think a pause might be. Does that help?
That was fantastic. You should do that again. Basically, no, it did not help.
Nothing. Under surveillance this morning, the latest manufacturing data out of China disappointing. The Caixin PMI falling to a 6-month low and below the 50 level that marks the difference between expansion and contraction. This not the only read of contraction for Chinese manufacturing. We had the official PMI come out earlier this week. Also, Lisa, showing a decline, and we've seen this pretty much across the board out of that economy.
And it's really going to only increase in terms of pressure on the economy if commodity prices remain high at a time when people are wondering, where is the node of growth going to come from? It was supposed to come from middle-class spending. It was supposed to come from the reopening. Now people are wondering, can it continue to come from the construction sector at a time when the government doesn't seem to want to support that? It's already overbuilt. They've already kind of tapped that well. Where do they go to then?
Balance sheet recession. I'm going to hear more and more about it. I know we are. Are they pushing on a string? Are they pushing on a string? Are we just starting to see that deleveraging kick in? And it doesn't matter what you do around certain policies, that people don't want an extra apartment. They don't want another car.
There is a feeling, and I've seen the speculation, could China be headed toward a lost decade, akin to what we saw in Japan? Is the deflation and the aging of the population, combined with the unemployment among the youth population and the way that they've stimulated their economy over the past couple of years, really lead to some very slow growth for a long period of time?
The problem with this conversation, of course, is that this could have just been a conversation we clipped from 10 years ago that we're replaying right now. It's not, by the way, it's live, but it could have been, right?
You probably could say that about a number of our
exactly
conversations.
the same things.
That's sad.
Plenty of earnings this morning. Caterpillar, don't be sad, posting a second quarter profit that beat Wall Street estimates as demand for its heavy machinery held up pretty well against expectations, sort of defying the doom and gloom once again. Seen as a bellwether for the economy, as you all know, given the critical role its equipment plays in construction, mining, and energy, and it's holding up okay. It's up in a pre-market as well, Lisa. A slight warning, I would say, about the third quarter not being as good as the second quarter, but still defying expectations.
I want to just dovetail this into our conversation about commodities. If Caterpillar is seeing incredible demand for building, for mining, for energy, what does that mean about the prices of all of these things, given that demand for them has been so much higher? Again, this goes to the question of how do we see ongoing disinflation if the good side of the economy is hanging in there much better than expected? That's why I find Caterpillar as a bellwether fascinating. People are looking at the good and not necessarily some of the more concerning elements that speak to inflation.
Do you talk lots about home prices? In the UK, it's an obsession.
Well, yes.
You spend a lot of time talking about home prices in the UK. It's just a thing.
Truth be told, I don't, just because I did purchase and then I watched the prices go down so much that I try to avoid it at all times. But at the same time, yes, a lot of people do talk about it, but not quite to the same degree as in the UK.
Spend loads of time on Zillow?
I don't.
I'm a Zillow addict.
I know you are.
Rightmove as well over in the UK. I love those websites.
What do you look for?
Anything. Just dream houses, houses that I might live in.
Farms.
Houses that I can't afford. Just everything. Do you
Little
not do that?
castles on top of
Very
rocks.
aspirational. Yeah, you know.
No, I look for vacation destinations.
Houses on the Amalfi Coast with a lemon
groves. A
just
cow.
stuff I'm never going to have, but that's
to make,
fine.
Gelato.
Precisely.
I know your vibe.
UK home prices falling at the fastest rate since 2009. The Nationwide Building Society said prices fell 3.8%, slightly less than the 4% decline that some people were looking for. The drop coming, of course, as the Bank of England sets to hike interest rates once again. They're already at 5%. They may well be going higher this Thursday. The two-year fixed residential mortgage rate over in the UK right now is through 6%. What matters here is that the effective rate, so that's the average rate being paid on the total outstanding stock of mortgages in the United Kingdom right now, is creeping higher, but not as quick as you might expect. We've gone from 2 to close to 3 from the starting of the hiking cycle coming into the summer.
Since I'm sitting here, if I were channeling Tom Keene, and you might get upset that I'm going to say this.
Sure.
How much of this is Brexit? How much of this is a lack of immigration? How much of this is the idea of a financial center moving, maybe even on the margins, to other regions in Europe that's affecting this as much as rates in a very idiosyncratic way?
Home prices or
Yes.
the inflation backdrop?
Home prices.
Oh, home prices I just think is the natural feed-through of the structure of the mortgage market in the UK. And you see that in the effective mortgage rate. The fact we're talking about a 2-year fix in the UK and we're talking about 30-year mortgages in the United States at like 2.5%, 3%. I'm not sure that's a Brexit factor. That's just the structure of the mortgage market, where you'd expect that bleed through from higher rates at the Bank of England into the housing market maybe a lot faster.
And people are basically expecting that to happen later, even if it's not happening now, because it's more imminent because of the short-term structure of those mortgages, and that's sort of the reason why.
Yeah, you'd expect to see more of it. There's going to be some pain there if this continues. You hold rates at 5%. I was going through some of the remortgaging numbers. I've got the number in front of me. 1.4 million are due to remortgage this year, so representing about a fifth of all households with a mortgage. So 5% of the total number of households. So bear that in mind. Those numbers from UBS more recently. But clearly, as the years progress and more people have got to shift away from what you could get in the pandemic for interest rates, it's going to hurt. And mortgage rates are going to go up.
This is the reason why I don't look at home prices, because I fear that if we were actually reflective of where rates really were, the prices would go down so much I don't even look. That's the truth.
Let's get to Guy Labat, Chief Fixed Income Strategist over at Janney Montgomery Scott. Guy, wonderful to catch up with you, sir. I actually want to start with credit because I know you're focused there. There's this line in the sand for you, and I'd love for you to talk to us about it. It's 400 basis points, high yield spreads, and we've dropped below that level, as you say, quite comfortably over the last month. Guy, what does that tell you?
So good morning, John. Good morning, Lisa. Starting in early 2022, about March to early April or so, high yield spreads widened considerably along with both the initial big increase in interest rates and the sell-off in equities. It started around that period. And since really mid to late April, high yield credit spreads in the U.S. have been generally holding above 400 basis points. And historically, 400 basis points is what I describe as kind of the Maginot line between healthy and unhealthy high yield markets. Typically, when you're north of 400, you don't see a lot of new issuance. New issuance that does come struggle. It also tends to pass through some effects into other markets like equities. And high yield spreads stayed above the 400 basis point mark really from that April period, give or take, with a couple of quick dips below, until roughly about a month ago or so. And for the first time since the initial sell-off back in 2022, high yield spreads have now held beneath 400 basis points, which I think is particularly constructive for a lot of other markets as well, because lower volatility on that higher risk element of the credit spectrum speaks to greater stability in all sorts of things such as equities. In some degree, it confirms the recent rally we've seen in the equity markets as well.
Guy, we were just talking about UK housing prices and how much more sensitive they are to rates adjusting to the higher level that we've seen them in recently. And we talk about how sticky the low rates are in the US when it comes to the housing market. It's also true when it comes to corporate financing rates. And we've seen that pretty consistently. And Lori Calvasina did some great work on that from RBC, showing just how locked in some of these low rates are for both high risk and low risk companies alike. How much do you think that is buffering the view of defaults in a way that changes if rates stay high for another year or 2 years?
So that's a really interesting point, Lisa. So in late 2020 into 2021, there was a huge refinancing wave, not just in the mortgage markets here in the United States, but also in the high yield credit markets as well. We saw issuers selling, 5, 7, even 10-year high yield deals and using the proceeds to buy out short-term debt maturities in order to reduce their overall coupon payments. So if you look at the U.S. high yield index, there's almost no maturities in the U.S. high yield index till about mid-2025, give or take. So as a high yield company, now there are exceptions, of course, but in general, it's pretty hard to default on your debt if you don't have a debt maturity coming due. So to some degree, that pushes out the risk of defaults into 2025, which, given the current range of economic outlooks from here, the world could look very, very different by 2025, either lower or higher interest rate, and probably on the road to a recovery after what I expect would be a mild recession. So the refinancing boom, the next round, really doesn't have to take place until after the sort of gap where we anticipate interest rates will be somewhat lower.
So just 30 seconds here. Do you think that people are too bulled up, or do you think that people are appropriately pricing in risk based on that assessment?
Well, I think we're reasonably appropriately pricing risk for the fundamental outlook. High yield leverage is low compared to historical aggregates. There has not been an excess of leverage that built up over this cycle for all sorts of reasons. Refinancing risk is low. So fundamentally, the risk is low. That said, if we do get another economic risk emerging sort of in late this year, early next year, I think high yield spreads are likely to drift wider in the face of that nonetheless.
Hey, Guy, thank you for the update on credit. Guy Labat there of Jenny Montgomery Scott. High yield spreads tight. An equity market looking out for all-time highs, just not expected to be here 6 months ago, were we?
I think that's the understatement of the year. Literally, people expected this to be a very bad year for risk assets, and it's been anything but.
Anything but. This morning a bit softer. No drama, though. We're down about 1/3% on the S&P 500. Looking out for earnings from the likes of Amazon and Apple coming up on Thursday, and looking out for data a little bit later this morning as well. Job openings. JOLTS, as they call it, and ISM manufacturing as well. If you are just tuning in, welcome to the program. The equity market is slightly negative. We're down here by 0.31%. In the bond market, yields a little bit higher by a couple of basis points, 398.29. Looking ahead to that economic data a little bit later, Dana Peterson at 8:30 Eastern time of the conference board. It's been a while. We haven't caught up with Dana for a while, Lisa, so I'm looking forward to hearing that conversation with you both.
I want to understand how long people can actually keep traveling around the world on things like cruise lines. I was looking at Norwegian Cruise, which came out, and they boosted their full year adjusted earnings per share estimate, which is, I guess, a good thing. And you see that the cruise days, just to give you a sense, Passenger cruise days. This is how many people love cruises. 5.78 million. That's up 93% year over year. Of course, it's a pretty low comp given where we were with the pandemic. Basically in line with the expectations, but those shares significantly lower, even though they did raise their expectations. Again, it has been a theme that we've seen, John, that when people report, the upside surprises are rewarded less and the downside surprises are punished more. So even with some of the enthusiasm we've seen in the index, that has been a theme.
One of the top 10 performing stocks on the equity market for the whole of this year. It's up 80% year to date.
Details.
Yeah, Carnival's up 133%. Royal Caribbean is up 121%. And the gains of these cruise lines this year have been ridiculous. Absolutely ridiculous.
Especially after being left for dead and incurring a lot of debt. Remember how much debt they really took on in order to maintain their ships during the pandemic, which were just basically parked, waiting for people to come.
I remember some of those high yield issues in the pandemic.
And people were saying, how are they gonna pay this back?
I was saying then, who's gonna get on a boat and go on a vacation and be stuck with people? And I'm saying it today, even after the pandemic, who wants to get on a boat? And apparently lots of people do, so what do I know?
Are you gonna take it back? 47?
No, stock is down 8% in the pre-market.
70?
This is not an equity call, all right? Just a lifestyle call. This is Bloomberg.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO. So buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Earnings season is here.
Decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it.
They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
When people talk about this environment, it makes me think of the sort of old Looney Tunes cartoon where the character is sort of running above the air, and you're not quite sure if they'll sort of crash or if some sort of parachutes will appear and help them float. And the key word is uncertainty. This is what we hear, we hear with our clients. They're not sure how markets will react.
A lot of head scratching this year, that's for sure. That was the Man Group CFO catching up with our team over in London a little bit earlier this morning. Uncertainty. There's always uncertainty, Bramo. It's never the absence of uncertainty about the future. It's just that a lot of people have called the future wrong so far this year.
I think people are saying uncertainty of trusting yourself, about your presumptions, about what's expected to happen, because everyone's assumptions have been completely wrong, to your point. And that, I think, is upending some of the confidence in the C-suite.
He described the Looney Tunes cartoon. You've got the character, sort of treading an air before it drops off. What's that, Wally Coyote?
Yeah.
I think so, yeah. Anyway.
It's like running and it doesn't
that was true of the pandemic as well. You had all that stimulus just holding the economy, suspending it in air when there was basically no economic activity in many places and many sectors. And I feel like we've been talking about that now for 3 years.
which is the reason why people are dropping it. And when you do bring it up and you are bearish, you get a lot of hate mail. I'm just saying, because people are saying, you've been wrong, you've done this for a long time, and it's not necessarily coming to pass. And maybe that's true. Maybe this time is different, and this economy has more strength than a lot of people have really previously believed.
I don't have the full context of that conversation, so this is not aimed at that individual, but I think just saying that line would mischaracterize where we actually have been. What we did was underappreciate the lag of that stimulus even after reopening and beyond the pandemic, the amount of savings that was left in the economy, the amount of refinancing that was done throughout the pandemic, both on the corporate side and for households as well, which is it's just meant that basically this economy has become less exposed to higher interest rates from the Federal Reserve. So to make out we're sort of suspended in thin air, I think it doesn't acknowledge the actual fundamentals of the economy so far this year. The consensus just got it wrong. This economy has stood up to these interest rates much, much better than most people thought it would. We were too preoccupied with the stock of debt and not the profile of the debt, the character of it, the maturity of that debt. And that's where we are right now.
And the intelligence of the homeowner and the intelligence of the C-suite in saying, if we can issue 30-year debt, we will. If we can borrow for that long and lock in these costs, we will. And during the pandemic, guess what all of those companies and individuals did? They refinanced their debt, got those low rates, and got them in for as long as possible to eliminate this exact risk.
It doesn't mean that you should extrapolate our current conditions over the next several years. It's just an observation about where we are and where people thought we would be, Lisa.
And it mitigates the potential risk, the potential downside risks to economic growth.
Let's talk about this stealth rally in the oil market. What did you say last month was best month since when?
It's been the best month since January of 2022.
Wow, quite a run for crude. Brent crude right now at 85. Regina Mayer joins us, Global Head of Clients and Markets over at KPMG. Regina, let's start there and talk about this run. And great to catch up with you, and welcome to the program as always. What's underpinning that rally through July, and can it continue through August?
Well, demand continues to outpace supply, and OPEC Plus, with its strategic cuts and even the Saudis' voluntary 1 million barrel per day cut that they've indicated they will extend through September, has created buoyancy in the crude markets, like Brent above 85, WTI once again above 80, and that demand is outpacing supply. There are some analysts that are saying when we're able to go back and analyze the actual demand figures, that July, given it was one of the hottest months on record, or the hottest month on record, and we still rely on a lot of fossil fuels to drive cooling, that July of 2023 will be the highest demand for hydrocarbons ever, outpacing August of 2019.
Wow. Regina, where's that incremental demand coming from? Has it been Europe, where we've had this massive heat wave, the United States? Has it come from China? Where's it coming from?
Well, China has just not given us the demand uptick that we keep expecting. I think I've been on your program multiple times, and it's always Chinese demand will pick up in the next few months. Chinese demand will pick up in the next few months. The thing that's really created the added demand is industrial activity is picking up in the Western market. So the supply chain challenges, the debottlenecking that's occurred, and the travel. You all were talking about cruise passengers. There's still tremendous travel consumption, tremendous bullishness in the consuming population. We continue to consume, we continue to travel, companies continue to produce, and that's driving record demand. On top of, it's a really, really, really hot summer, and it takes a lot to drive the cooling that we need.
And it also is interrupting some of the processing. There was a piece out this morning talking about how the very hot weather has reduced some of the refining capabilities of certain companies. You also are seeing some of the shipping costs for even natural gas rising substantially over in Europe. How much is this fueling a call from you that oil prices are going to go substantially higher, even natural gas over in Europe?
I'm not as bullish that the prices will continue to go higher, Lisa. I do think that supply continues to meet this record demand that we're facing, and we're going to get a peak, right? Summer travel is in the U.S. is starting to tail off. I know in Europe it's kicking off for August, but there's an end to that. And so I don't think we'll see the big spikes that we've seen in the past. I think that demand continues to or supply continues to roughly meet demand. The story in the gasoline price spikes that we've seen in the U.S., it's just inventory. It's inventory. And motor gasoline and refined products don't move around the world as well as as crude does. So they are very geographically specific. And in the U.S., motor gasoline stocks, inventory stocks, are down to its lowest level since 2015. I think that is a remarkable statistic.
How do they rebuild that, especially at a time when there is concern about the Strategic Petroleum Reserve of the U.S., and there's a question about rebuilding that, and there is a lack of refineries in the United States?
Yeah, so the refining industry has contracted significantly, but it's also incredibly more efficient than it ever was. Refineries are still running pretty flat out. The statistics I was looking at showed roughly 94% utilization throughout the month of July, which is really about as high as they can get it, maybe 95, 96, but just a little bit, a few basis points above what they're currently at. But we will see summer driving season come back down. The demand for motor gasoline will rationalize, and the refineries will be able to catch up. We will see a short-term spike in gasoline prices, but I do see consumers seem to be less reactive to the price at the pump. Our survey KPMG recently did, 49% of consumers say they're moderately or concerned about the higher price of gasoline. That's down from 70% last year at this time. So I think there's less price sensitivity in terms of gasoline consumption as well.
Regina, how do you differentiate between less price sensitivity and prices just not being as high as they were last year?
Fair point, John. But I do think because of this consumption boom and that there's inflationary pressure across a lot of activities, we've seen price spikes in different commodities like eggs over time, and the prices for experiences and restaurant activity, travel costs, and we still see consumption moving. So I do think there is perhaps less price sensitivity overall with the consumer. Maybe we're becoming more immune to some of the inflationary impacts. That'll only last for a certain period of time, but I do think we're benefiting from that lack of price sensitivity.
Don't tell the airlines. Regina, thank you. Regina Mayer of KPMG. They don't need encouraging, do they?
No.
Not at all. I'm complaining on behalf of me and everyone else, by the way.
Thank you. Even in terms of how much they've jacked up prices and people keep paying it, it's ridiculous.
The customer experience all round has just sort of like fallen off a cliff.
So what is your view on the lounges?
You know my view on the lounges.
You don't go?
I don't go to the lounges.
Ever?
Rarely. You might see me in one now and again, but rarely.
Because they're too crowded?
Often at certain airports, you're better off just going to get a meal somewhere else.
We don't want to wait in line with people?
I'll give you an example.
Tiered.
Delta at JFK. Didn't they open a new lounge there? Because Delta in the last 12 months, the lounges there have just been, there's lines going around the corner.
Especially right before.
Seems to me you just sort of get a credit card. This is not a credit card. I just wanted to hold something up. It's my name tag to get into the building. Seems to me that you get a credit card and you spend a bit of money for a month and you get top tier at these airlines and you can get in any lounge you like.
Well, you can get into the lounge.
Flying.
Well, but this is not without flying. You need to show a ticket. It's not quite that much.
No, you can have a ticket, but sure. But usually you'd acquire points through flying.
Right.
And
but
now it's just spending.
Correct. However, people are tiered. I always think of airlines as being sort of the key, I don't know, class kind of conscious moment where people are basically tiered for what kind of medallion you are and what kind of...
No problem with the class system up in the air. I've got no problem with it at all. Just, let's establish the class system through effort and through miles flown and money spent on the airline.
Well, they make a lot of money.
And not just sort of like spending. I go to the restaurant and I get double points with my AA Advantage card.
Well, you can buy it at the airport and then get extra points.
Anyway, you know my thoughts on this, and I think a lot of people familiar with them now as well, so I look forward to catching up with Ed Bastian if he ever wants to come.
I look forward to getting out of here.
Talk about it. Michael O'Rourke of Jones Trading joining us shortly.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. Yeah. There's nothing closer than the phone in your hand.
The names that move markets are on Bloomberg.
Concentration in industry after industry after industry is a threat to our economy. It is a threat to innovation, and ultimately often leads to price gouging, whether it's consumers or the government. I believe in the power of markets, but they only work if we enforce the rules that keep competitors going rather than monopolists.
Nobody covers business like Bloomberg, your global business authority.
We're going into a different, higher nominal GDP world.
When the Fed pivots, that's when the new cycle emerges.
Even though the labor market is still quite strong and the balance sheets are quite strong, there's still risks out there.
The two things that we're watching most closely on the economic front are productivity and oil.
I think I can state with a high level of confidence through the end of this year, we're going to remain recession-free.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The smell of capitulation. There's a lot of catch-up trades out there this morning. Live from New York City. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. Your equity market is down by 1/3%. Yields on the long end just a little bit higher. The dollar stronger against the euro, more so against the yen and against sterling, going into a Bank of England rate decision later on this week. This note just popped into my inbox. It comes from Patrick Shallis over at Gordon Haskett. Shout out to Patrick. It says catch-up calls, Nirvana calls, and then just says, exclamation mark across the top of that email. Thank you for that. So we've got an upgrade from Citi, new price target there. They look for 5,000 by the middle of next year. And let's call out someone who actually got it right, though. John Stolfus of Oppenheimer, who looked for 4,400. That was his year-end price target, year-end last year. And he was looking for 4,400. So this upgrade, I think that's notable. He looked for 4,400. It's come early, and he says, look, we can have some more in 2023.
I remember him coming on the show and talking about his price target. And I looked at him and I said, aren't you worried about the rate hiking cycle? Aren't you worried about the idea that we might get recession? Aren't you worried about
being wrong again after being wrong last year?
Exactly. And he was like, no, I'm not. Like, sure, you can always be wrong, but you have to look at the dynamism in the economy. And I thought to myself, no way. And you know what?
Hey, here we are.
He was absolutely right.
NASDAQ with a rip-roaring rally. A little bit later on this morning, you'll get some economic data. Job openings in America, it's called JOLTS. jolt, which we all just sort of talk about now, at job openings, we're expecting them to come down. Then ISM manufacturing later on this morning, look out for that too. It's important. Manufacturing's been softer recently, starting to stabilize. Can that converge to services? A conversation Lisa started again a little bit earlier this morning. Earlier on today, more data out of China, another read of manufacturing, disappointing, contractionary. The PBOC out with some headlines moments ago. We spent the last couple of minutes trying to translate some of this into English for you. So they're going to guide banks to adjust existing mortgage rates lower, just reiterating some support to keep the housing market stable. But ultimately, Lisa, this is something they want to see improve, an area of the economy they want to do something about.
The lack of clarity here comes partly because of a translation issue, but also partly because there aren't concrete steps being taken. And this seems to be, as you've said before, this posture of easing that doesn't have a lot of details. How much does this sort of add to that, this idea that they're trying to somehow backstop the housing market in a way that doesn't include reinflating it? How do they plan to thread that needle at a time where they don't have that much appetite to sort of reignite some of the leverage that has really been built into the housing market?
It's an easing posture. I don't think anyone right now would describe it as aggressive monetary policy or fiscal stimulus when they say things like, we'll continue to implement prudent monetary policy. We want to support the healthy development of the property market. It's quite incremental stuff, Lisa. The hope is you get more of it and it adds up in the coming weeks and months.
Just simply shrinking the potential down payment that people have to make and cutting rates isn't going to be enough at a time when a lot of people aren't working and have questions about the state of the economy. So to your point, to the extent that this can actually support anything remains to be seen. In the equity markets, though, people seem pretty excited. So there you go.
Not this morning, at least. In China, they have been. Last week, best week of the year for Chinese equities. The hope around EM more broadly, we touched on it a little bit just yesterday. The rate cuts are arriving. Chile, perhaps Brazil later this week. You get an easing stance out of China and EM equities start to look a little better. Isn't that the call?
That has been the call. And I wonder if we start to see on the margins capitulation, because you've seen a pretty incredible rally in emerging market debt and FX in particular, especially because I was looking at South Korea and some Thailand, some of the other Southeast Asian nations that are affected by the contraction that you're seeing in China. And you're seeing some of the export numbers to China go down. So at what point does this start to have a bit of a cycle in some of the areas that have benefited from other aspects of the global economy?
Let's whip through the price action just to get you all up to speed. Just briefly, we're negative here by 0.3% on the S&P. Yields are a little bit higher. We talked about Treasury yields higher by 3 basis points or so, just south of 4%, 398.89 in the FX market. The dollar's shown some strength today across the board in G10 against the yen, against sterling, against the euro. A break of 110, 109.76. We're negative here by 0.2%. Joining us now in this equity market, Michael O'Rourke, Chief Market Strategist at Jones Trading. Michael, when you start to get a little bit of capitulation out there, you start to see these price targets track the rally we've seen so far year to date. Just engage me in the conversation around sentiment. Michael, do you get nervous when you start to see that?
I'm not going to say I get nervous when I start to see it, but what you're definitely seeing here is people's, they're reacting to price. They're reacting to a market that's been extremely strong in the first 7 months of the year, and they're questioning that, their expectations coming into the year. My note last night was I titled it "Too Early to Declare Victory," because we still have 4% inflation. And although the Fed may be done tightening or is very close to being done tightening, the market's acting as if it's the actual rate hikes themselves that are the headwind. It's not the hikes. It's living with those higher interest rates, those higher that higher real Fed funds rate that's going to tighten on the economy the longer that persists. So you can't celebrate the Fed being done, because now we have to live with the tightest environment we've had in 15 years or so.
Well, Michael, when does it start to bounce? And that's the trillion-dollar question. 6 months, a year, 2 years? Just how long and variable are these lags?
Well, you're right. It is the trillion-dollar question, and that's why I think it's funny. Everyone's saying the recession calls are wrong and such, but they were pretty widely held at the start of the year. And the Fed itself, its own forecasts for growth, et cetera, are much lower. The fact of the matter is they didn't tighten policy enough to slow inflation to the rate they wanted to. So because policy wasn't there to bring the appropriate slowing, we still have an economy that's been gangbusters all year. I mean, up until this last jobs report, we were averaging over 300,000 jobs per month. we only need to add about 80,000 to keep the unemployment rate from rising. So we still have an unemployment rate near 6-decade lows. So, it's understandable. The economy's grown over 2% the first half of the year. We haven't slowed yet. But again, we still are going to slow, and it's going to have to happen to get inflation down. So I don't know why everyone's celebrating at this point in time.
But Michael, momentum. Why not jump on the FOMO trade if it's worked? I mean, this is really what people are saying to us. And at one hand, I want to laugh and be like, really? Is that really what you're saying? And on the other hand, they've been right. I mean, they basically are saying that there's too much energy to keep things going up to really fight against it.
They have been right, and you're correct about that. But for everyone who's been right, how many people consider, how many people in their forecast said that 7 stocks would drive 65% of the S&P 500 gain this year? So, yes, we have an up market, but it's not necessarily a healthy market. And again, no one was predicting that you'd have trillion-dollar companies rallying 50 to 200% in 7 months. So, yes, they've been right on one measure, but, they got there the wrong way. So I think that should urge caution, because you can't rely on 7 names to carry the market indefinitely.
What would you have to see in terms of a broadening out of the rally, a healthier kind of move that would make you feel a little bit differently, that would make you actually lean in a little bit more to this rally?
I mean, we have seen some positive signs, so I don't want to be totally negative here. Like, we've seen the Russell come to life in the past couple of months. The Russell 2000. I think that's a good sign. Again, I think what we all want to see is value stocks start outperforming, because again, they're a big portion of this market, and every growth rally seems to wind up in this. The capital seems to wind up in those 7 names. So I think those are things you want to see. I've said it before here. I'm a big fan of the banks. I think their problems are behind them, and I think there's a massive opportunity here. But again, while it seems like they're through the worst of their troubles, they haven't performed, obviously up to par with some of those big momentum names. So I think there's many opportunities in this market, because the narrow leadership made so many other groups so much cheaper. I think that's, or less expensive. That's how people should be looking at this market. They should be looking for those opportunities than chasing 7 names.
What about bond yields? A lot of people are betting on the Fed cutting rates next year, even as you do see sustained profit recoveries, just simply because of this immaculate disinflation. Do you think that that's the case, or do you think that yields could go higher even still, as you say, and really pressure things the longer that the Fed keeps rates at an elevated level?
Well, obviously the Fed has said they want to keep rates, higher for longer, but they've also said they will cut rates as inflation goes down. So I believe there'll be a point in time, and it might be late next year, that they'll start reducing rates. But I think that real interest rates adjusted for inflation are going to be higher. I mean, we've had a negative real interest rate environment for the past 15 years, for the most part. And now what the Fed is theoretically saying they're going to do is we're going to go back to a positive real interest rate environment, which is where we are now, and maintain that going forward. So basically, the Fed's rate cuts should barely just keep up, or not even keep up with, the pace at which inflation decelerates over the next year. So we're still going to wind up with a tighter monetary policy environment.
Michael O'Rourke at Jones Trading. Michael, thank you on the latest in this market. And the Federal Reserve and this determination to keep some kind of positive real rate, Lisa, even as inflation comes down.
This is one of the most, to me, the biggest aspects of the tightening policy that people seem to discount, that the Fed's going to cut rates before they really even take effect. This question of, okay, well, if you hold it there for long enough, all of a sudden the refinancing actually matters, because these companies that have locked in these rates will actually accept higher rates.
There's a maturity wall out there somewhere. It's just not right here all at once.
But Guy Lebas is saying that really the maturity wall for example, high yield comes in 2025. So if we get to 2025 and haven't brought rates substantially lower, you could be looking at some more weakness, but 2025 is a lifetime and nobody really cares about it.
Well, even if they are lower, they're higher than what some of these companies paid on their debt to begin with.
But that's my point. So there's going to be the tightening that has very long lags through the economy, especially if there is strength, especially if we don't get a recession, which really raises a question, when do you start pricing that in? People now seem to be saying, la, 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 we don't care, because that's really far out there, and that seems to be working.
We don't have to think about it right now. Are you doing that? Sort of head in the sand and
Yeah, it's great. Yeah, happy
wonderful.
summer.
Have a good time.
Yeah, that's me. You know, that's how I always work.
What, sort of head in the sand, pretending it's not happening?
Operation, what, Bank of Japan?
BOJ has been Operation Ostrich for a while. It's just hoping it's not happening. The communication for the BOJ recently is slightly odd.
That's a good way of saying it.
Slightly odd.
Did you see Winthin yesterday? He actually got angry. He was just like, Ueda, come on.
Disappointed in Ueda.
Yeah.
But we had disappointments around. I remember Chairman Powell, when he started, President Lagarde. You make mistakes. Remember President Lagarde, we're not here to close spreads? Okay, sure. If you're just joining the program, welcome to the program. The S&P 500 negative 0.3%. Joining us in about 18 minutes' time, Dana Peterson of the Conference Board, catching up with us about 8:30 Eastern Time, going into lots of economic data a little bit later on in America. We have job openings and the ISM manufacturing read as well, Lisa. All of that later this morning.
I'm very curious to see ISM manufacturing in particular, especially given what Andrew Hollenhorst of Citigroup was saying earlier this morning, that he actually thinks we could see a stabilization and a re-expansion, a re-acceleration in manufacturing. So manufacturing not dragging services to meet it, but the other way around, actually coming up to join services as people start to really double down, particularly with some of the housing sectors and other areas that have really revived.
That's what Neil Dutt has been talking about for a while over at Renmark. Need to catch up with Neil soon. Up next on this program, we'll catch up with Elaine Becker of TD Cowen on the airline industry, and we're going to talk a little bit about airport lounges and what's happening with that at JFK and beyond. Really important conversation is why we booked her. We got in touch with her about 10 minutes ago.
All I could say is, unpopular opinion, I like the lounges. It's just, they do get crowded.
I like them when they're empty.
I enjoy them.
I enjoy them when they're quiet.
When there's nobody else there.
When no one else is there.
Go to Alaska.
Go to Alaska. Is it quiet?
There was no lounge.
Oh, right, okay. So one of those airports.
It's actually a huge shipping airport. We can get into that later.
Okay.
It's actually a really
We can do that in a commercial
story.
break.
That's
I
good.
can't wait. It's going to be a good one. All right, from New York, this is Bloomberg.
Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Today, PJT Partners CEO, founder, and chairman Paul Taubman sits down with Bloomberg Sonali Basak for an exclusive deep dive into the state of business. Tune in live at 10:45 a.m. Eastern, only on Bloomberg, your global business authority.
The American consumer has been pretty resilient. Our industry is very resilient. We're seeing growth for the industry back in the mid-single digits, which that's really where it was pre-COVID and pre this kind of COVID super cycle. We are still seeing premiumization within the consumer. Prices, so what's driving the growth is really the super premium priced products.
Deborah Crew there, the Diageo CEO, the distiller. Brewery, what are we calling them? Drinks company? Lisa? Distiller?
Spirits industry.
Whiskey? Scotch?
Did you see Heineken? They didn't do that well.
What did they do?
They had disappointing earnings, and we're seeing questions around beer consumption post-pandemic after.
People don't drink beer anymore.
They say that people drink it, just less. And then spirits are like, oh, but we're back in
Is that a demo thing? The younger
I don't know.
demographic
I actually
aren't
was trying to do some research and then got lost in a whole host of
Because they
articles.
tried to get the younger demo hooked on hard seltzer and stuff like that, right? I say hooked, but obviously they always say drink responsibly. So
you're going to do that too? Well, I think that part of it probably is craft beers too, because there's been a real shift toward craft and not necessarily. Maybe I'm just skewed by New York. I don't know. These are the questions that I've really not solved.
They're really important questions. Let's look at JetBlue just quickly. Keep it together. JetBlue right now is negative by 6% in the pre-market, slashed its full-year profit outlook. Listen to this. Adjusted full-year earnings will be 5 cents to 40 cents a share, compared to the carrier's earlier outlook for 70 cents to $1. This came from JetBlue, Lisa, earlier this morning. We talked about the numbers themselves. The numbers themselves this morning were pretty much in line, but the outlook pretty dreadful.
Interesting to me that this really highlights the international travel over the domestic. And this really goes to business versus families. I think of JetBlue as being a very family-centric kind of vacation airway because it really focuses on a lot of routes that tend to foster that type of travel. I wonder how much that really highlights the international trips that are really fueling all of the numbers that we're seeing out of the travel industry.
I've said for ages, I've always thought JetBlue needs a rebrand.
Why?
Because too many people think it's the same as Spirit. And I don't think they did themselves any favours by pursuing the acquisition they were pursuing. Yeah, it just, I think they do. They see it as a low-end budget carrier. I've flown tons with JetBlue.
Have you flown with Spirit?
Transatlantic, no. Transatlantic and across this country to California. They have a great offering on JetBlue. It's a fantastic airline. I wouldn't consider it a budget low-end airline in America, but you ask people who haven't flown it, I believe that's what they think it is.
Well, it has good rates to islands and warm places from cold places, and that's the reputation that I've known it as. But I think that you're right. It tries to distinguish itself as both a low-cost airline while also having a modicum of quality, and it's a hard needle to thread for a lot of people.
It's like we're premium Ryanair, but we're not Ryanair. And they're really not Ryanair.
And they're not Frontier.
No, exactly. That's what I'm getting at.
Frontier is like you pay for the air you breathe.
That's what I'm getting at. Yeah, you've got thoughts on that. I know you have. Helene Becker joins us now, Senior Research Analyst at TD Cowen. Helene, let's talk about these airlines and the distinction that Lisa draws between the performance of the domestic-focused airlines and international. What's happening in the two markets at the moment, Helene?
Well, Lisa hit it on the head. We are seeing very good demand on the North Atlantic, especially, and we're seeing less good demand in the U.S. domestic market. And what we have been thinking is that 2021 and 2022 were all about U.S. domestic because there really wasn't a lot of places to go internationally. And now that the international markets are open again, people are traveling again. And we think this summer is all about Europe, and next summer will be all about Asia, especially because the U.S. passport is not going to get you as far as it gets you now. Beginning in 2024, you're going to need a visa to go to Europe. You're going to need a visa to go to the U.K. You can do it online, but it's going to cost you extra. And so I think you'll see that shift away from European countries to Asian countries.
We've got a playbook with regards to that, Helene, when we introduced the ESTA visa for Europeans and others to come to the United States. Does it really hit travel in that way, given how easy it is to actually complete the thing? I remember many years ago, I used to have to do that when I came to New York. Will it actually move the dial on visitors to Europe?
Yeah, I think it'll be a combination of that, and I think fares have been really, really high this summer. It's turned a lot of people off if you didn't book really early, and then and I think as Asia reopens, it's kind of, you know, we did Europe, now let's go someplace new, and I think that's the trend you're going to see probably beginning after Labor Day this year. And then going into 2024 and 5, and it'll probably be 25 before we get whatever normal is going to be, you know, that single-digit growth that's probably sustainable. The 10-20% growth we're seeing in the industry, we've seen in the last couple of years, is just not sustainable for a whole variety of reasons.
I have to say, we've done Europe, now let's do Asia. It makes it seem like we're all just living in this herd mentality of post-pandemic reality. Helene, I'm looking right now also at visas to go to Europe, and they range from, it looks like, €7 to €40, depending on where you're going, although I could be getting this somewhat wrong. Helene, how much is this driven by business versus personal travel? How long can individuals and families continue to pay prices that seem pretty sticky and unresponsive to demand pressure in any way?
I've been trying to figure that question out too, because the answer to that too, because it seems to me when I go on a plane and I make a right turn, all these families are making a left turn. And I'm trying to figure out, gee, I paid a lot of money for my ticket. I booked it 2 months ago. Or 10 weeks ago, and how come you're going there and I'm not? and I think that there's going to be pushback. I mean, I do think that people will just say, okay, we bought all our stuff during the pandemic, and then we did all our traveling after the pandemic, and now we're just going to get back to kind of a normal lifestyle of working, because I think over time, as we get further and further away from the pandemic, companies are going to require people, even in a hybrid environment, to come to the office more often than they've been going. And that won't lend itself to traveling Thursday to Tuesday or Thursday to Monday. And then business travel will shift, right? You'll see that shift in mix. You're laughing at me.
Well, no, I'm not laughing at you. Just the image that you paint of everybody who's not working, going with their families, paying through the nose to do Europe.
I thought Helene was going to give us a commentary on newborn babies and business class and whether they should be allowed in there or not.
Well, she can if you want to. Well, I'm just sitting here wondering, how long can people keep not working and spending all their money? Have you seen any signs of pushback on the pricing, Helene, as of yet? Or is all of your anticipation of that simply an extrapolation of pure logic?
Yeah, I think it's a combination of both. We have seen pushback on pricing. You've seen domestic prices come down pretty much on a year-over-year basis from really levels that, again, were not sustainable. So you're still above 2019 levels, but we're below 2022 levels. So I think that's a positive. And then, when you think about shifting demand, airlines can shift demand by lowering ticket prices, and people will respond to that. And then the last thing I would point out is in terms of visiting friends and relatives, China was closed for years, right? 3-4 years. And it opened earlier this year. And you don't see a lot of business travel there, some business travel. You don't see a lot of leisure for sure. But what you do see is a lot of people who couldn't get home for a couple of years going home. So that's the trend. And then 6-8 months, a year later, you start to see tourists pick up. But for sure, we're seeing pushback on pricing. And every Tuesday, I get fare sale offerings from a lot of the airlines. Just sign up for the email alerts to monitor discounts. And the discounts are deeper than they were 6 months ago. So yes, we're seeing some pressure on price.
Helene, I've got 10 seconds, so just pick a name. Favorite airline right now? Which stock is it?
Yeah, we're still on United.
Okay.
Lower domestic and higher international.
Scott Kirby, getting it done over United. Helene, thank you. Helene Becker of TD. Cam, we never got to Ed Bastian and Delta, but maybe another day.
Maybe we could talk about lounges. I'm sure everybody was just really excited to hear talk about. I think they're done.
They're living it.
Okay.
So many people listening to this are like,
it's
so done with the
small
airlines.
violin, though. It's a small violin. I mean, I agree with you, but
Sure.
you can just go and get
just the whole thing, the way they treat you when you go through security. I've got, the whole experience is just dreadful.
It is, but it's gotten a little better on the edges.
The flight attendants are great. I'm just talking about the sort of like the preamble before that.
Yeah, the preamble is pretty rough.
Sure.
sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready? Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stenivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
About an hour before the U.S. Open. Welcome back. This is Bloomberg Surveillance. We're seeing just a touch of weakness in equity markets after the fifth straight monthly gain, which is the longest streak going back to 2021 on the S&P 500. You can see a bit of dollar strength, a bit of euro weakness, 109.56 on that cross of euro dollar. 10-year yields just a touch higher, about 5 basis points to just over 4%, 4.01%. Crude. I'm really watching crude, actually, because I'm curious how long we can keep this rally. A little softer today, just a touch, $81.28 on the NYMEX. But we have seen the biggest monthly gain going back to the beginning of last year at a time when people talk about this as being one of the significant underpinnings of this disinflationary trend that we've seen borne out throughout the global economy, really. Coming up in about 90 minutes' time, we are going to get a slew of data, ISM manufacturing, as well as the JOLTS, the job openings data. Michael McKee, Bloomberg International Economics and Policy Correspondent, joining us here in studio. Mike, what are you looking for that you think is really going to be telling? What matters more, the JOLTS or the ISM manufacturing numbers for the Federal Reserve?
Well, I think in a sort of short-term compressed context, you're going to want to look at JOLTS because that's what the Fed has been looking at to tell them about how tight the labor market is. And right now we're looking at a drop, according to the survey, of about 224,000 job openings. What'll really matter is the jobs to unemployed ratio, which is about 1.6 now. We'll see if that goes down. It's still higher than 1-to-1, which is what the Fed is going to be looking for. With ISM, we're still looking at contraction, but the question is going to be, does it improve a little bit, and what happens to prices paid and employment? We've seen this contraction, but it hasn't really hurt employment all that much in manufacturing. Does that start to happen? So those are things that are going to tell us kind of what's happening with the labor market, which is what the Fed is mostly focused on now.
For a couple of days now, we've been talking to strategist after strategist about how everything is awesome and the U.S. economy is doing phenomenally, and why not just keep on feeling enthusiastic. And then on the corners, a couple people say, well, take a look at credit contraction, which has been ongoing, perhaps not a massive fissure. But yesterday, the Senior Loan Officer Opinion Survey came out and confirmed what Fed Chair Jay Powell said. There is a significant amount of credit tightening going on at the banks. How significant is that in terms of historical precedent and what it says about recession?
It's hard to actually say because while the Fed has been doing surveys of bank lending since 1964, the real data doesn't start until the mid-1990s. They've rejiggered the survey a couple of times, and that puts us with only 3 recessions, and it doesn't really give you an indication of what leads or not. In the 2003 recession, banks tightened a little bit ahead of time, but then you go to the great financial crisis, and they didn't start tightening their standards until we were already in recession, and obviously low standards were a reason for the recession. So it's hard to say whether it's going to correlate directly to it, but we have seen essentially what the Fed's looking for, a tightening of standards that in theory should bring down demand. Nothing terrible, but it should bring down demand, which is what their goal is.
And maybe that could create the softness in the labor market that can then create this disinflation that isn't too harmful. Michael McKee, thank you so much for being with us. We will follow up, I'm sure, throughout the day and week with some key employment data to round out the week. Right now, we are expecting the JOLTS report in about 90 minutes' time. Dana Peterson of the Conference Board weighing in on this, saying, quote, the June JOLTS data will give us a clue as to whether companies are taking down job ads and workers have slowed the quitting trend. Both will be important signs that the labor market is cooling without massive layoffs. If workers believe that there are fewer options, then they are less likely to quit and more likely to moderate spending. Dana Peterson, chief economist at the Conference Board, joining us now. Dana, how much evidence are you seeing of this kind of trend of workers getting less of the upper hand when it comes to demanding wage increases and working from home?
We're not actually seeing much there. When we look at the hard data, we still see lots of people quitting. That's why the JOLTS data today will be so important. And the key thing is that businesses are still hoarding labor, and they're also still hiring. We hear that from our CEOs. And so if you're a worker and you know your boss is not going to let you go because they are afraid of losing quality talent, or they think that if there is a downturn that it's going to be short and shallow, then you know that you have some job security there and you're not going to moderate your spending, as I mentioned.
So we're not expecting necessarily to see a big softening in the labor market. Pretty much everyone is saying that. You might see some moderation, but not significantly. We have Citigroup coming out this morning and saying they actually expect a reacceleration in the ISM manufacturing data, which was one of the weaker spots in the economy. Is this a backdrop for inflation continuing to cool, or do you challenge that? Do you think that because of the labor market strength, because of what we're seeing in the rest of the economy, it's difficult to say that?
I think it's difficult to say. I mean, certainly when you look at manufacturing, it has been in recession because consumers are no longer buying goods only because now they can get out there and buy services. And of course, we've been talking a lot about travel, and certainly that's what people are doing. So it's hard to imagine, at least in the short run, the manufacturing sector, turning back around anytime soon. But certainly we have to pay more attention to services. That's the bigger part of employment. And certainly that's still being bolstered by the fact that some industries still haven't recouped all the people that they lost during the pandemic in terms of layoffs. And again, companies are holding on to labor. And with that holding on, they're also increasing wages and benefits, which is quite costly. And that feeds directly through to inflation.
Dana, earlier this morning, John and I were talking about CVS and how they're engaging in another round of layoffs with their corporate offices, not necessarily in their frontline workers in stores. How much has this continued to be a white-collar recession in ways that really aren't really fully represented in the overall data? In other words, there have been pockets that have seen much more substantial layoffs and weakening than really is expressed at the headline level.
Well, I believe people think it's a white-collar recession because when you look at who's getting let go, it's people in tech and finance, and those tend to be white-collar jobs. But we have to remember, tech and finance did incredibly well during the pandemic. There was a lot of demand for both, and there was a lot of overhiring in both of those sectors. And so now we're seeing right-sizing in finance and technology. We are seeing some of the layoffs spread out to other areas. But the reason why you're not seeing blue-collar workers being let go is because most of the demand is for services that are in person. You have to show up to, and there's not a lot of supply of labor for those types of jobs. And so that's why you're still seeing a lot of churn there. And that's why it seems like it's a white-collar versus a blue-collar recession. But I think it's more about labor shortages versus not.
How much have we corrected the labor shortages to really create confidence that we've avoided some sort of wage spiral?
Well, that's why the JOLTS data are so important, and I like to look at it, even though some people have issues with it, because you can look at how many job openings there are versus how many people are actually being hired. And I look at that as vacancies. And you still have a tremendous amount of vacancies across almost every industry. Only some, like construction, can go in and out from month to month, but most every industry is still saying that we have a lot of job openings and we're just not finding those people. And indeed, when we ask CEOs what you think, Many of them are still saying that they're concerned that they won't find qualified workers over the next year. That's from our 2Q survey, and we're hoping, we're definitely going to see updates to that in our 3Q survey coming out this week.
Dana Peterson of the Conference Board, thank you so much, and we'll be catching up with you soon as some of that data becomes a bit clearer. Meanwhile, talking about employment, Uber came out with their earnings earlier this morning, and they paid up for their drivers. They said that they did increase their spending in order to attract, I believe, 33% more drivers in order to cater to a record amount of ridership. Joining us now is Mandeep Singh, Senior Technology Analyst at Bloomberg Intelligence. Mandeep, this really highlights the incredible demand for drivers, for Ubers, even at a time when the prices are going up tremendously. How long can it last?
I think it just goes to show that Uber is a clear category leader now, especially when it comes to mobility. On the delivery side, look, they are growing 14% when inflation is high single digit. It's not great growth, and freight is declining business. So everything when it comes to Uber is driven by how well mobility does. And right now there is that summer seasonality, which I think is helping. But when you look past the summer seasonality, the growth is somewhat tapering off because some of it is driven by pricing, some of it is driven by share gain from Lyft. We know Lyft is growing low single digits. So Uber's category leading position is what's driving this, but I worry about the total end market growth going forward.
There's also a question about consumer pushback on some of the pricing. We were talking about the employment and how a lot of the drivers are getting more when it comes to being lured into work for Uber. You also see prices going up just generally in order to pad their profits.
Yeah.
Is there pushback? Have we seen it?
Well, so I think the numbers suggest, given the supply growth, right now there isn't a lot of pushback. And look, it's as a platform, it offers you that flexibility that you can work part-time, you can, drive your income. But I still think when it comes to take rates for a platform like this, having 20% plus take rates and not being able to show leverage in your business is worrisome. I mean, Uber is at a run rate of $35 billion a year. So you have to ask yourself, at what rate will this business start generating some serious free cash flow? And right now, you don't see that. The share count is going up. The free cash flow, the adjusted number is, yes, healthy, but it's all driven by mobility. So in the end, you have to ask yourself, is the delivery business really complementary? Is the freight business really additive to the business? And the answer probably is no.
Does the weakness that we saw in the freight aspect point to some other slowdown, whether it's just in general with goods or whether it's a broader consumer discretion, at least pull back a bit in certain areas?
I mean, with Uber, they're the number 5th or 6th when it comes to the freight side of the business. At least on the mobility side, they're a category leader. And look, the volumes are low. We've seen that with the other transports data that we follow. But look, they're trying to position themselves as a digital company that is a marketplace. It's an asset-light business. It just doesn't reflect that. And the way the business is being run, the insurance costs, I mean, that's a wild card with this business. They will come up with a quarter where the insurance costs just balloon and the margin leverage goes down. So that's where the sustainability of free cash flow or, how this business grows over time, it comes into question because you can have these abrupt quarters where some cost item will spike.
Which is a reason why we end up with a situation where some people are wondering whether the mobility aspect will be purchased by a big auto manufacturer who will then end up running it as a perhaps autonomous driving fleet. If you're just joining the program right now, you do see the S&P lower by about 0.4%, 45.95.25. We're talking with Mandeep Singh of Bloomberg Intelligence ahead of Thursday as well. Amazon and Apple coming out with some pretty big earnings. And I'm just wondering, so far, we said these massive gains in technology companies. The earnings seem to confirm it. Do you expect that to continue, or do you think that, as with Uber, there are signs that this isn't quite sustainable over a longer period?
I mean, especially when you look at Apple, this is all discretionary. People upgrading their phones or not, and if they're raising ASPs, my sense is that would slow down the rate of upgrade. So clearly, you will see some signs of, at least whether the hardware demand is picking up or not. And with Amazon, the AWS business, if large language models is the craze, they should participate in that, and they've taken down their AWS growth rate, so that's something to watch out for.
Do you think that one of the big auto manufacturers is going to buy Uber?
Well, I think it's too early because Uber first has to divest its freight business for it to be, and really what they are going to do with the delivery business. So it's still too early for that. And we haven't seen any signs of autonomous driving being a real business. You want to see signs of that first.
Mandeep Singh, thank you so much for being with us ahead of a really big week of earnings. We did get Uber earnings, just to repeat, better than expected on the profitability side, surprise profit. However, in the freight particular aspect, a decline, which you're seeing pretty much across the board as packages and other shipping comes down. Right now, you are seeing a bit of softness in markets, just a touch lower on yields as well, as people anticipate a slew of data, including manufacturing across the world. We have seen that recession in manufacturing. Does it continue in the United States? Coming up, Jonathan Miller of Miller Samuel on housing. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
On the next episode of The Circuit.
I was like, this is a way to change culture. Like, what a different world. Of course, we know for girls, it means so much to have female athletes to look up to, but for boys, to look up to women also, it's really for everyone.
Watch The Circuit with Emily Chang, Thursdays, 10 p.m. Eastern on Bloomberg Television, or 8 p.m. Eastern on Bloomberg.com or the Bloomberg app on connected TVs.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Pretty hard to default on your debt if you don't have a debt maturity coming due. So to some degree, that pushes out the risk of defaults into 2025, which, given the current range of economic outlooks from here, the world could look very, very different by 2025, either lower or higher interest rate, and probably on the road to a recovery after what I expect would be a mild recession.
The locked-in cost has been one of the key buffers to what we've seen that otherwise would have been a likely credit cycle, both when it comes to corporations and individuals in areas like housing. That was Guy Labat, Chief Fixed Income Strategist at Janney Montgomery Scott. We are looking at markets a bit softer. We have been talking all day about the UK housing market and how much prices have declined. We're talking 2009 levels at a time when the U.S. has been ebullient, amazingly resilient, defied all expectations, bizarre, however you want to categorize it. Joining us now to do a much better job than I could, Jonathan Miller, President and CEO of Miller Samuel, who has an overview of U.S. housing markets and global housing markets at a time where it has befuddled pretty much everyone. What's your take on the resilience in a U.S. market that should have been brought down by these higher rates akin to what we've seen in the U.K.?
Right. It's the difference between variable and fixed rates. Most of the world relies on variable mortgage rates. And in the U.S., people are locked in. And actually, the reason why we don't have a lot of inventory, and inventory is the metric to focus on, or lack of listing inventory. And that's because people are wedded to their low rates because rates were probably kept too low for too long.
There is a study that I was looking at. U.S. homeowners are nearly twice as willing to sell if their mortgage rate is 5% or higher, but just 1 in 5 mortgaged homes meet that criteria. In other words, they have such low rates, they're not going to move.
Right. It's like 80%. Yeah, 80% are sort of just sitting and waiting. There's uncertainty. Everybody's expecting a recession. We've been forecasting a recession in 6 months for 2 years. People are just sitting. When consumers are uncertain, they sit, they wait. And as a result, and also too, people that may want to buy, they have to sell their house to do it, but they can't find a house. So they're stuck. Inventory is extremely low across most of the markets that we cover.
Could you give us a sense, a historical precedent of the last time the inventory was so low, basically the number of homes on the market that you could potentially buy?
There hasn't been. The inventory now, for example, in Florida is 60% below pre-pandemic levels. Many housing markets, you're looking at inventory 30, 40, 50% lower than it was in 2019 before the pandemic, when rates really dropped and demand surged and there was a frenzy. I'm not sure people realize how extensive the obliteration of listing inventory was during the pandemic with rates being so low.
Well, so here's the question. Right now we see home builders going nuts, building as much as they possibly can because there is no inventory and people need a place to live. If rates do come back down, if there is a glut of new housing supply, could you see prices go down dramatically when the door is actually open to true price discovery?
I think so. I mean, the way to think of inventory coming back into the market, if rates drop substantially, they're sort of in the 6s, high 6s and low 7s. If they're in the 5s, maybe we start talking about more supply coming on. But we have unemployment at 3.5%. It seems like there's more rate cuts in store just on that item alone, which sort of goes in the opposite direction of rates falling.
We were talking earlier about the UK, and I do want to just wonder if there is any corollary to what would happen in the US if there were variable rates. We saw prices fall at the fastest pace going back to 2009. In the United Kingdom, they do have variable rates. We talked about that earlier. Would that be what we would see in the U.S. if we weren't shielded by a 30-year mortgage rate?
Absolutely. That's, the idea here is that the psychology is people are, locked in and they're able to enjoy a lower rate while people new to the market can't. And there's a premium for that. And one of the premiums is to sit and wait. It's a luxury, rather, that to sit and wait. You don't have to, we have home equity at, some of the highest levels in history. There's no stress for people having to sell. The economy's pretty good. People just sit and wait. And so I think this whole process is going to take time, which as opposed to, a few years rather than a few quarters.
One thing that some people will say is that the housing market has bottomed and that you're seeing a recovery. Is that an accurate way of characterizing a market that's essentially stagnating?
So I think when you refer to that, the reference is really to pricing, because pricing has leveled off and is rising in some markets from pandemic highs, if you will, but sales activity, is still way off, and the rate of descent is slowed. It's somewhat stable, but sales activity is held back because of inventory, and inventory is held back because of high rates, and high rates are held back because of low unemployment. I mean, it's just this whole domino thing.
Talking about the domino effect, you speak to a lot of mortgage brokers, I'm sure, and people who work in real estate.
Yes.
What's the mood like?
Well, it's interesting. Over the last year, there's been this sentiment that, hey, rates are going to come down. And I keep asking the question, with unemployment, at or near record lows consistently, how can rates be cut? maybe they'll drift lower if the Fed stabilizes for a while. I think it's reasonable to expect that, but not a sharp decline. The economy is still too strong on the unemployment side. So it really, the Fed is going to have to keep using their baseball bat to damage the economy.
Well, if the rate structure, if we stay at around 5.5%, or even if we go down to 5%, say, for a full year, what does that do to inventory? What does that do to the mortgage market?
So first of all, that would be great to get things going. Rates in the mid fives even, I think would pull a lot more people into the market, which would not in a panic sort of flood of inventory, but it would normalize to a certain degree, and we see transactions pick up. Right now, because of the lack of inventory, we're seeing bidding wars start to approach 40-50% of local housing markets, meaning sales that close above the last asking price. We're seeing some big numbers in certain markets, and that's because of chronic lack of supply. So the demand is still there, even with higher rates. So New York Metro is a prime example, and Southern California another example, where we're seeing bidding wars at nearly half of the closed transactions in the last quarter.
Are you seeing any soft patches?
Not really. I mean, soft patch to me would be defining it by price. Pricing is stable in terms of activity, sales, that is. Certainly, almost every market is very slow, and it's because everybody's stuck. No supply, no sales.
Is the Sun Belt still as hot as it used to be? I mean, is it still as popular, I should say, as it used to be?
Or I'd say it's hotter than outside the Sun Belt, but to use that same phrase. But but not as robust as it was. But I think in a lot of the Sun Belt markets, inventory is even tighter than in, say, markets like the Northeast, where inventory, while it's in many markets 20% off of pre-pandemic, it's not 60% off.
Jonathan Miller, thank you so much. This is really one of the most fascinating times I could possibly imagine for the housing market. Of Miller Samuel, I look forward to reading your next report, which will highlight all of the latest trends. Coming up on Bloomberg Technology at 12:45 p.m., Dara Khosrowshahi, Uber CEO, following earnings that had a surprise profit, record number of riders, giving more to attract a greater number of drivers, but a bit of weakness on the freight side. Right now, what we're seeing in the markets is a bit of softness after the longest streak of monthly gains in the S&P 500 going back to 2021, defying all expectations, up almost 20% year to date on the S&P 500. We do have from Oppenheimer this projection of a 28% gain to 4,900. John Stolfus over there by the end of this year. Others joining the fray as people say this can continue, because what's going to stop it, and why fight momentum? Euro a little softer versus the dollar, 109.57. Just a touch higher in the yield space, 4.03% on the 10-year yield, and crude just a touch softer, but watching that after the biggest monthly gain going back to January of 2022. This was Bloomberg Surveillance. Join us on radio and the Bloomberg Open coming up next with Jonathan Farrow.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power of the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open
for regulators to do more. And that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO. So buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Five months of gains on the S&P 500. Can we make it 6? Live from New York City this morning. Good morning, good morning. Equities down 0.4%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
From New York, coming up, the bulls on Wall Street are getting even more bullish. Another economic data point out of China disappoints, and one presidential hopeful confronting the Fed. We begin with the big issue. The bulls get more bullish. Oppenheimer's John Stolfus looking for a record high before year end, increasing his price target for the S&P to 4,900 and saying this: our price target assumes that the resilience exhibited by the U.S. economy will continue. Citi's Scott Croner is on board, increasing his price target and looking for 5K by the middle of next year. He says our new S&P 500 targets reflect a higher soft landing and lower hard landing probability. Clearly, we're chasing the tape. However, growing conviction in earnings growth acceleration is a key point of difference. JP Morgan's Marko Klanovic is doing what he's done all year. He's pushing back on soft landing hopes and dreams, saying, quote, we remain skeptical of this outcome, anticipating the inflation decline to prove incomplete, leaving restrictive policies in place, laying the seeds for an end to the global expansion. Joining us now to discuss, Morgan Stanley's Michael Kushner, Aberdeen's Luke Hickmore. Luke, first question to you, sir. Which camp are you in?
I think I'm still in the recession camp. I feel torn about it, but I still feel the risk of that is very, very high. We've very, very rarely had a Fed hiking cycle of this kind of pace without a recession caused afterwards.
Michael Kushner, do you agree?
I'm more on the optimistic side. I think a softish landing is what's going to happen. Doesn't mean we won't have potentially negative GDP growth for a couple quarters, but kind of like early 2022, small negative, but with a resilient labor market, it won't feel like a recession. But slower growth, but nothing too bad.
Michael, tighter financial conditions, we're seeing it in bank lending survey after bank lending survey. We heard it from Capital Economics yesterday, who said this: despite the optimism surrounding the real economy's performance over the first half of the year, credit conditions have historically only ever been this tight during or in the run-up to recession. Michael, why is this time different?
I think it's the resiliency of the private sector, the strength of the consumer, the household, the corporate sector, the pre-planning for what's happened. The Fed transmitted exactly what they were going to do, refinancing in the housing market, refinancing of debt in the corporate sector. Won't say there won't be specific problems, won't be problems amongst the different income parts of the income distribution or certain high-yielding companies who leverage too much or a business model doesn't work in the new environment may happen, but systematic or systemic weakness, it's hard to see. My analogy is still kind of the mid-1990s when the Fed raised rates 300 basis points in 94, and 95 turned out okay. A significant slowdown, but nothing disastrous. Fed moved to cut rates. I think that'll happen towards the end of 2024.
Luke, from your perspective, what's your key point of differentiation?
I think it's really hard to get away from a lot of corporate profits being driven by inflation. It's pushed up nominal growth. It's pushed up revenue growth. They've benefited from that as well. There's been a lag in terms of passing it through for wages. That's starting to hit. Just as inflation starts to come back down again, nominal growth is going to come back down again. The optimism that abounds at 23 times PE for the S&P 500 just seems way too far when we're coming into a period when all of that's going on. It's going to start hitting the market. I think seasonality, September, October, we've seen it before. We could just see a wobble again this year.
Luke, that's the equity side. What about the credit side with high yield spreads in and around south of 400 basis points through much of the last few weeks?
I really want to love IG credit here. It's the right time to be getting into that market. High yield, I feel, is not up with events, is not pricing our expectations of a slowdown or even a recession as far as my view is concerned. IG market should be the sweet spot for that. But it's moved so far, like the S&P, like so much of the equity markets around the world, the levels we're now seeing short-term are starting to look rich again. Do you know, with cash rates where they are, with government bonds where they are, that's not a bad investment right now.
Michael, you disagree on the outlook, the economic outlook. Do you agree on the trade in the market, what you just heard from Luke Hickmore?
I think in the short term, there's no doubt that credit has done quite well in the last couple of months. High yield is, but it tends to track the equity market. The S&P up 20%. Is it surprising the high yield market is up as high, high single digits after its disastrous year last year? How often does the high yield market have a double-digit negative return 2 years in a row or a negative return 2 years in a row? Almost never. So I think the rebound we have is perfectly reasonable. Going forward, I still think we're on track for potential in a 9-10% return in high yield this year. Our view is more about not getting too defensive. That weakness is a potential buying opportunity, not a selling opportunity, or sell strength, buy weakness.
Michael, do you think that avoiding recession is sufficient enough for this to continue, this grind higher in equities, this grind tighter in spreads?
It can over the remainder of the summer. I think the Fed has pulled back from hiking rates. There's likely a good chance they won't hike rates at all or not till November. We're in a period where economic data has been strengthening. The labor market is rock solid. I think there's no reason why Friday's employment report shouldn't be fine. I'm not saying it won't be below 200,000, above 200,000, but it'll be fine. The unemployment rate shows no signs of going up. The manufacturing sector may be bottoming here. It may not be weakening any further. While the service sector is likely to continue to stay slower than it was 6 months ago, manufacturing doing a little better. Overall, it looks okay.
More economic data coming up later this week. Payrolls on Friday, 200K is the headline estimate. Unemployment expected to come in and around 3.5%. You look at that, and I would use Michael Cushman's language, things look okay. Joining us now to discuss is Bloomberg's Ira Jersey. Ira, data out a little bit later on this morning as well. What are you and the team looking for?
Yeah, so I think the ISM surveys are going to be really interesting before we get that critical payrolls report on Friday. The ISM surveys have been kind of weak and hovering near recession, but not in recessionary type levels. So I think that those will be really interesting to watch. And also the prices paid components, particularly of Thursday's services sector, because that has continued to be above 50, and we've seen the strength in prices in the services sector even much more than the goods sector. So if we see that prices paid tick up again, then that can be a sign that maybe we could get a reacceleration of inflation, particularly in that stickier services sector.
Where would it leave your outlook, Ira, if you did get manufacturing converging towards services?
Yeah, well, if manufacturing gets back up toward services, then you'd have to think that stickier inflation would be the case. I think then for the rates market, what would probably happen is we'd start pricing out some of the cuts that are being priced for the first half of 2024, and if that happens, you wind up probably with kind of a bear flattening of the yield curve, which is pretty unusual to occur.
Given where yields are right now, 10-year at something like 4%, Ira, do you think the disinflationary momentum that we've witnessed over the last month is sufficient just to chase yields lower from here, or do you want to see more?
Yeah, I think it is. I think a big part of that is a big part of what would get 10-year yields significantly lower has to be that inflation doesn't reaccelerate, right? So the opposite of what I just said, effectively. So as long as inflation continues to come down toward levels where the Fed's not hiking anymore, then ultimately the market's going to price for the Fed at some point in the future. I'm not saying in the next 6 months or 9 months, but maybe in 2 or 3 years for the Fed to cut, say, below 3%. And if that happens, and the market expects the Fed to stay at, say, 2.5% for a long period of time, then you wind up with 10-year yields that can rally quite significantly. It doesn't necessarily mean that the front end has to move very much, but the back end would probably rally in that scenario.
Ira, thank you, sir. Ira Jersey of Bloomberg Intelligence on the rates market and the economic data out a little bit later this morning. Job openings coming up, of course, alongside ISM manufacturing on to Friday when we get the payrolls report. Michael, you alluded to it. That spread right now between services resilient, manufacturing dreadful. Do you actually think manufacturing can start to converge up towards services?
Well, I think there's been a lot of technical factors driving manufacturing weaker, both in terms of pent-up demand during the pandemic or 2021 into 22, which satisfied a lot of forward demand. Inventories got built up too much in 22, had to be run down. Imports are still falling year on year right now in the United States, which doesn't augur well for manufacturing in the short term. But on the other hand, you talk about global deglobalization, re-onshoring, the CapEx boom, government subsidies to manufacturing chip plants, solar energy, manufacturing. All these things point to demand for capital, demand for to build things. I bet you I don't know for sure, there's a shortage of workers. Some of the constraints on building things will be the absence of the ability to hire people to staff factories and things like that. So I do see the manufacturing not weakening. How much stronger against, I'm not sure. Service sector clearly has to soften a bit. We're not saying economy won't be strong. I don't think 2.5% GDP growth annualized is going to continue in the second half of the year, but it's not going negative.
Luke, are you taking the other side?
A little bit, I guess. I agree completely with Michael about the onshoring, but there's an whole other thing going on here as well called friend-shoring. So look at Japan, look at the rise in the equity market there recently. A lot of Southeast Asia democracies are taking business away from China as well. It doesn't just have to be the US that sees the employment growth there and actually a tight labour market continue. And in the meantime, we've seen a lot of layoffs recently in high-paying, white-collar jobs, knowledge industries. That's going to hurt the economy broadly as well. I find it really, really hard after 3-4 years of real wage decreases for either the consumers to continue where they have been doing or companies to actually continue with a cost base that's affordable when revenue growth is starting to run out. So yes, we may get a capex increase. We may get 1 or 2 decent quarters of earnings, but that slowdown's coming along. It may not turn into recession, fair enough, but I think it could end up feeling a bit like it.
Luke Hickmore, Michael Kushmer, you're both going to stick with us. Let's get you some movers going into the opening bell. Equities right now just a little bit softer. The Open Abbey about 20 minutes away.
Indeed, John. And despite that softness, we do have a couple of big winners to take a look at relative to earnings, starting off with the shares of Arista Networks, up more than 10%. At this point, up 14.4% as the cloud and communications networking company beat and raised. That was the type of quarter they put up, very strong, and analysts encouraged by the fact that it was a diversified revenue stream. Uber up 1.25%. They reported their first ever operating profit. It was fueled by demand for rides and delivery. Ridership also reached a record, so those shares being rewarded. But Norwegian Cruise Line, not so much, down 10.3%. The adjusted earnings for this quarter, they guided to 70 cents. The estimate on Wall Street, John, had been 79 cents. They raised the full year view. Some more color is needed on this beneath the surface. Yields appear to be holding, cost weighing. As you know, these stocks up huge. Into today, up 80%. Price for perfection Investors didn't get it, stock is down.
Abby, thank you. Coming up on this program, the disappointing data out of China continues.
I guess one thing is just we have to lower the expectation for China's growth. The past 3 years, we have seen plenty policy that's been damaging, let's say, for a couple of sectors there. It's a very slow healing process here.
That conversation up next.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
On China, I think many people expected that coming out of COVID that it would rapidly go up. That has not yet happened. There's been some signs from the government they're taking some action, but we will see how that unfolds in the second half of the year. Things that they're doing on the real estate side to maybe get that situation going a little bit might have a positive effect on consumer sentiment. We shall see, but I think it's too early to tell how that's going to develop.
More disappointing economic data out of China. Manufacturing contracting in July, falling to a 6-month low. Monthly home sales dropping the most in a year, underlining the need for further government support. This as Beijing delivers another pledge to jumpstart the recovery, including boosting consumer and business spending, reviving the housing sector, and perhaps cutting rates. Bloomberg's Tom Orlick joins us now for more. Tom, you're an expert on this part of the world, and I'm going to lean on you to tell me what they're actually doing. Not what they're telling us, what are they doing?
So the cavalry is on the way, Jonathan. Unfortunately, relative to past cavalry arrivals, this one's looking rather lackluster. We're not talking about 100 stallions here. We're looking at a few rather mangy-looking old nags riding up to support China's economy. 2008, they delivered $4 trillion in stimulus, enough to restart the economy, but also leaving them with a huge legacy of debt. That legacy of debt now making it rather hard for them to deliver enough stimulus this time round.
Tom, are we starting to see, sorry to jump in, Tom, but do you think we're starting to see an emerging balance sheet recession that they can't do much about?
So the balance sheet recession analogy, Jonathan, comparing what's happening in China now with what happened in Japan in the 1990s, has a certain amount of resonance to it. China, like Japan, has got a huge amount of debt and a huge amount of overcapacity. Producer prices in deflationary territory, and consumer prices, well, the CPI is close to zero. So there are some comparisons which make sense there. At the same time, there are also some big differences. Japan in the 1990s was already a rich country. They'd run out of space to grow by catching up to the global technology frontier. China's GDP per capita is just a quarter of the level in the United States. That means a bunch of development space ahead of them. China's policymakers are also keen students of history. They've looked at what's happened in Japan in the 1990s, and they'll be taking steps to ensure they don't have a repeat performance. That's why we've seen a certain amount of policy support coming in. The PBOC's cut interest rates. They've instructed banks to guide mortgage rates lower. We expect them to do more in the months ahead. There's also been some important signaling. The government spent much of the last 3 years cracking down on the private sector. In the last few weeks, they've really reversed on that and indicated firm support for the private sector, firm support for small businesses and entrepreneurs. Is that going to be enough to get China's growth back to the go-go years? Absolutely not. Debt's a problem, overcapacity is a problem, demographics is a problem. They'll do a bit more than 5% growth this year, but in the years ahead, we're looking at 4% on the upside. But do they have enough firepower to prevent a slump, prevent a slide into a Japan-style malaise? I think they still do.
Hey, Tom, wonderful to get your input, as always. You wrote the book, literally, China, the bubble that never pops. Tom Warlick there, down in Washington on the latest. Michael Kushmer, Luke Hickmore, alongside us with some thoughts on this. Michael, this is what a lot of people who are long, say, places like Europe, hoping that global growth picks up. This is what they're pinning their hopes on, that China can do something about growth has disappointed so far in 2023. Do you think they can?
They do have policy levers to pull. They've cracked down on the housing market. Everyone thought, well, we certainly thought they might come to the rescue a year and a half ago to the property market, given how important it was for the economy. They didn't do it. They continue to focus on debt reduction and reduction of leverage in the system. That obviously has to continue to get things back in balance. But on the other hand, like today, we're seeing a slowdown in post-COVID opening that the economy is not recovering. I think ultimately the problem is that we had a manufacturing boom the last couple of years post-pandemic. China benefited from that, exporting things to the rest of the world. And that's come to an end. We've had a service sector boom. China is not well positioned to benefit from a service sector boom and going forward. How are they going to grow and catch up to Japan and other parts of the world unless they grow the non-manufacturing part of their economy?
Massive week of gains in the equity market last week in China, biggest week of gains of the year so far. Luke, it's easy to identify where the hope is right now. The hope is they deliver something big and growth starts to kick in with a little bit more strength than we've seen so far in 2023. Luke, do you share that hope?
Yeah, I guess I do. I think China's important for us all, and we are still a long way off from thinking about China as its own economy that's just enclosed, that's mostly domestic, that's shifted its manufacturing base to more of a domestic demand. That's years and years away. We all need China to be doing well. We need them to recognize they've got an important place in the world politically and economically and actually be part of it. And I think that's been part of the issue recently is, they've been trying to find, or Xi Jinping's been trying to find his space and what he thinks the country should be doing. And it's been holding it back, I feel. And that may be starting to change. Some of the noises recently may start to change as well. But short term, let's see the stimulus come in. Let's see what it is and how it's likely to react before we can get too excited about China as an equity market from here through.
Luke, elsewhere, are you seeing more opportunities within EM versus DM right now? And I bring that up because we're talking about China potentially taking on more of an easing posture. And we're talking about rate cuts in emerging markets as we talk about the end of rate hiking elsewhere.
Yeah, for some of my unconstrained funds, we've been buying a bit of emerging market debt. And it's really trying to get hold of this change in the rate cycle, which happens there first. I think we'll see a lot of that coming through in places like Mexico and Latin America. They put their rates up a lot quicker, a lot higher. They'll come down the other side too. So local currency EM debt seems to me a pretty good place to be right now. We've been just allocating more to it as well. We've seen clients coming into that space too. And I think it's a good market to be early and still get good carry if it's going to take longer than you expect for rates to come down.
This is the final question, Michael. Have we found some common ground between you and Luke? EM.
I think we have. Local EM has done very well. We've seen rate cutting cycles begin in Hungary at the margin, in Chile. These things could be very rapid. In places like Brazil, real rates are very high. You could potentially see 400 or 500 basis points of rate cuts and still rates be on the high side. And with the inflation cycle turning in the U.S., it's low in China. Importantly, commodity prices, food and energy needs to stay reasonably under control. That's a very big component of the inflation story in EM, and falls in those inflation rates allows central banks to adopt a greater easing cycle, strengthen their currencies, further bolster the ability to cut rates. And you get into a virtuous circle of falling rates lead to capital inflows, lead to currency strength, leads to capital inflows, leads to further rate cuts. And you get this very positive cycle, which can last a while. And we're only beginning the rate cutting cycle. So we could have 12 months of really good outperformance in that sector.
That is the EM dream, described by Marco Kushma, alongside Luke Hickmore. To the two of you, thank you, gents, as always. Going into a central bank decision later this week from Brazil. Let's see if they follow Chile, who cut rates pretty aggressively going into last weekend. Equities right now, negative 0.4%. Coming up the morning calls and later, JP Morgan's Monica DeCenso says stocks are heading to another record high. That conversation up next.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open. Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
About 4 minutes away from the start of a brand new trading month on the S&P 500 going into it. Futures slightly negative, we're down 1/3%. That's the price action. Let's get used to morning calls. Atlantic Equities upgrading Goldman to neutral, seeing limited downside and encouraging signs from the company's latest earnings report. Your next call from Citi, downgrading Estee Lauder to neutral, expecting a slower recovery given the recent weakness out of China. And finally, Cantor downgrading Rivian to neutral, $29 price target, citing valuation and competition concerns. That stock is down to about 27 in the pre-market, negative here by almost 1.7%. Coming up next, JP Morgan's Monica DeCenso raising her outlook for the S&P 500, expecting stocks to hit a new all-time high within the next year. That conversation up next, your opening bell just around the corner.
stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Let's get trading started officially for the month of August. Equity futures going into that opening bell. Negative here by 1/3% on the S&P and the Nasdaq. Down about 0.4%. 5 months of gains on the S&P 500. Longest monthly winning streak going back to 2021. Can we continue the winning streak? There's the opening bell. Switch on the board and get to the bond market. Your 10-year yield shaping up as follows. Yields up and away this morning, higher by 5 basis points, back through 4%, 4.0129% on a 10-year yield. A little bit later this morning, 30 minutes away. ISM manufacturing and job openings in America. In the FX market, a bit of dollar strength, a bit more against the yen and sterling against the euro. We're negative by 0.2%, 109.76. It's a break of 110. In the last couple of days. In the commodity market, we pulled back on crude, $81 on WTI. We're negative there by 0.7%. Crude, over the last month through July, best month of gains, Lisa was telling me a little bit early this morning, since early last year. So decent month of gains so far for crude, and let's see if it continues into August as well. One stock to watch at the opening bell, Caterpillar, shaking off slowdown concerns and posting better than expected Q2 earnings. The CEO saying this: our results reflect continued healthy demand as we achieve double-digit top-line growth. Abby has more. Hey, Abby.
Hey, John, and this is really a very impressive quarter and a tell, to your point there, potentially on the global economy, that this recession that we've all been waiting for, well, it's really not showing up in these results. They beat in a big way. Specifically, they put up $5.67 in adjusted profit on $16.5 billion of revenue. Not small numbers. That represents a 5.7% and a 25% beat. That's the degree of strength that they are seeing. So very resilient demand for the company's iconic yellow machinery across all of the business segments. Double-digit revenue growth, machinery growing by 16%. Compare that to your Microsofts and a lot of the other big tech companies. Caterpillar is blowing them right out of the water. So this is one of the companies, many companies, I should say, that has successfully handed along higher prices. But on big ticket items, the stock, John, right now having its best day since June 7th on the year, up more than 10%. Caterpillar is certainly a piece of the breadth that we're starting to see for the market rally.
Let's see if we see more of it for longer, up 3% this morning. Abby, thanks for that. Some mixed results elsewhere from Big Pharma. Merck raising its annual sales forecast. Pfizer trimming $1 billion off their own outlook, but remaining optimistic, saying this: despite a few revenue challenges, we believe we're positioned for accelerated growth in the second half of 2023. Simone Foxman has more. Hey, Simone.
Yeah, John, Pfizer cutting about $1 billion off of its full-year sales forecast, but keeping its full-year guidance on its COVID shot and pill at $21.5 billion. However, it says that those drugs are responsible for a second quarter revenue that declined by 54% from a year ago quarter. Ex-COVID sales growth, that's the big focus of investors, because they revised their estimates down to to 8% for the year versus 7 to 9% as it was earlier. Where does the growth come from now that the pandemic is past? That's a big question. Merck having a bit of an opposite problem. It actually saw better than expected results from its two top drugs. Cancer drug Keytruda, second quarter sales up 19% from the previous year. HPV shot Gardasil, second quarter up 47% year on year, especially because of increased demand in China. But investors really trying to figure out where does the growth come next. Both of those have patents that expire in 2028. So looking to the end part of this decade, John.
Ismail, thank you. Pfizer pretty much unchanged. Merck a little bit higher, up by 1.7%. JP Morgan reiterating its bullish view on Merck following its results. The analyst saying, we continue to view the company as having one of the cleanest paths to upside to both near-term and longer-term numbers in the group, estimating double-digit EPS growth through the late 2020s. And while shares have re-rated over the past year, we continue to see the stock as attractive. We remain overweight. Merck is up by close to 2%. Getting back to earnings, shares of Norwegian Cruise Lines are sharply lower after delivering weaker than expected Q3 guidance. The CEO saying, quote, we are focused on sustaining this momentum by capitalizing on robust demand and ultimately charting a path to reducing leverage. Katie has the story. Hey, Katie.
Hey, John. Yeah, Norwegian shares really plunging in the wake of that report, currently off by about 10% or so. They were lower by as much as 16% pre-market. And to get into the numbers here, Norwegian sees adjusted third quarter EPS at 70 cents. Analysts were looking for closer to 79 cents. And that's dragging down the stock, even though the company beat on its earnings and it lifted its full year EPS outlook. And actually, Norwegian is on track to sail more customers this year than it did pre-pandemic in 2019. You wouldn't know that by looking at the shares necessarily. It's dragging down its peers as well. Think Carnival and Royal Caribbean this morning. And it's probably because, in part, the bar is really high for these names. If you look at an S&P index of hotels, resorts, and cruises, currently up about 45% this year. That is double the S&P 500's performance.
3 of the top 10 stocks so far this year before today were cruise lines, which is just kind of nuts. Katie, thank you. It's been that kind of year so far. Let's wrap things up with Uber, out with earnings this morning, reporting its first ever operating profit, fueled by record demand for rides and deliveries. The CEO, Dara Khosrowshahi, saying these milestones were achieved through a combination of disciplined execution, record audience, strong engagement. We are well positioned to sustain long incremental profit generation. Ed has more. Morning, Ed.
Yeah, good morning, Jonathan. The stock is down 5.5%, completely reversing direction from pre-market trading. Broadly, the sell side sees this as a solid quarter. Net income of $394 million was a surprise. Analysts were expecting a loss of $49.2 million. Record ridership volumes in the quarter, but you have to realize that a big factor behind net income was unrealized gain in equity investments, which was a large contributor. It's the first ever profit on a GAAP basis, $326 million, free cash flow $1.14 billion. They're forecasting gross bookings of $34 to $35 billion in the third quarter, ahead of expectations. Adjusted EBIT will be $975 million to $1 billion, ahead of expectations. We also got confirmation that CFO Nelson Chai will step down effective January 5th. That confirms the Bloomberg reporting from early July. The search for his successor is underway. Number of trips, gross booking, active drivers all hit record levels in the quarter just gone, which tells you both about the demand but also the supply picture. The freight unit continues to see losses on an adjusted EBITDA basis. Finally, John, headlines from the call. Uber CEO Dara Khosrowshahi addressing the idea of competition with Lyft and saying that for the time being, this is going to remain a two-player market for, quote, some time, acknowledging also that Lyft is being more competitive on a pricing basis. Right now, a lot of focus on continued growth in both grocery and delivery for Uber Eats.
Lyft also down this morning. The earnings about a week away, a week today. Ed, what do you learn from this release from Uber about Lyft next week?
Yeah, it's interesting that they acknowledge the effectiveness of what Lyft has done with its new CEO in response on pricing. Insurance costs have been a really big factor for Lyft in the prior 2 quarters. Going to be asking Dara Khosrowshahi about if they also are worried about insurance costs. But if it's going to be a two-player market for some time, that signals to me that we've got to continue looking at pricing. What are you going to do to stay competitive on the demand side and the ridership side?
Thank you, mate. Lyft is down by 4%, down by 3.8% right now. Uber's negative by close to 5 percentage points. Lyft numbers come next week. Coming up on Thursday, you know the two big names we're looking for, Apple and Amazon. Sitting Stuart Kaiser making a case for sticking with big tech this earnings season.
Earnings growth is still relatively scarce. If you look at the drivers of performance this year, EPS momentum or positive revisions to consensus numbers have been a key driver of returns of the leadership of the market, and we think that continues. I think the core view remains tech and growth because I think growth is still scarce both in the U.S. and globally, and it's large cap U.S. equities which have that growth. So we're not ready to pull the cord on that one quite yet.
Let's continue that conversation. We can do that with JP Morgan's Monica DeCenso. Monica recently upgrading her outlook on the equity market. Monica, let's start with that outlook. What's it driven by and what's the number now?
It's driven by, quite frankly, fundamentals for the U.S. economy that never turned out to be as bad as people thought when they came into the year. And so we were bullish equities at the beginning of the year, thought we'd get to 4,600 by year end. Obviously, we got there a bit faster than expected. And so when we looked at our outlook again and re-underwrote our thesis, we said, hey, this is a market that is stronger than we thought. And it looks like, quite frankly, the U.S. consumer is stronger than we thought. And when you add that up with reasonable valuations, broadly speaking, you can see a scenario where equities can still return 6-7% over the next 12 months.
So the numbers I'm looking at, 4,800 to 4,900, perhaps by the middle of next year. Monica, when you think about the opportunities, do they lie at the market cap index, S&P 500, or elsewhere?
Yeah, I do think this is an interesting setup for equities because you, for the first time in many years, have the opportunity to look beyond big tech. By the way, I still think tech looks fine. You still want that growth in your portfolio. But for too long, people relied probably too much on a few sectors. And now we actually look at this rally and it was very disproportionate. And it's time to look under the hood of the S&P and figure out where is their value? Where are their secular opportunities? I think you saw from Caterpillar this morning, industrials could be a place that look a little more interesting. And in fact, when you peel out those large cap tech names, you find cheaper valuations versus historical levels. So I do think it's time to return to fundamentals, if you will, look at valuations and look across sectors rather than being heavily leveraged to just one or two parts of the market.
Well, let's talk more about sectors. Outperformance in July, the banks up 10%. Let's talk about size. Small caps up 6% on the Russell versus the S&P up something like 3%. Monica, can we start with the banks? Do you see reason for that bank rally to continue?
I think you saw that rally, obviously, coming out of what happened with the regional bank crisis earlier this year. You saw everyone just sell down bank exposure broadly. And at the end of the day, there still are opportunities. You want to be selective with the regionals because there are some that have balance sheets maybe that are less strong or have more commercial real estate exposure. But broadly speaking, when I look at some of the larger banks, they still look fundamentally fairly strong. And that's both the equity side, and we also look at things like bank preferreds, which sold off very meaningfully and can be a really interesting way to get yield within a balanced portfolio today.
I noticed that you've dialed back your view on Europe, just relatively speaking, to the United States. Monica, can you walk us through that?
Yep. It's actually a quite similar story to the U.S. We called for Europe outperformance at the beginning of the year. That happened, especially when you think about it in dollar terms, helped by good fundamentals as well as obviously a strengthening euro. So today when we look at it, just think it looks more balanced. Like the U.S., I think there are pockets of opportunity. I look at the energy sector, for example. You still have many names that are trading at deep discounts to their U.S. counterparts. And so I think it's just about being selective in sectors and stocks rather than owning the broad market as your only way to get market exposure in Europe.
So, Monica, two things. You've picked out energy potentially out of Europe, industrials potentially out of the United States. How much exposure cyclically are you taking at a time when some people think eventually this recession is going to bite and it's a mistake to extrapolate out the recent resilience through next year?
There is no doubt that after this equity rally we've seen, we don't want to be too levered to any one part of the market. I think when I look at what the market is giving us today, and that's how I think about where to add exposure, I see a disproportionate rally, right? Some sectors driving a lot of the outperformance. I see high rates and I see low volatility. And so I look at those three parts to think about cobbling together interesting returns over the next year. I think equities will give you positive returns, but do not ignore fixed income and the fact that you can get very similar returns with maybe different risk, thinking about parts of the fixed income world. And so I like to have that balance. And over the next 6 months, we may very well see volatility. You may get chances to lean in a little more heavily broadly to equities. But I think my message here is don't be scared of this rally, just be a little more selective.
Well, let's wrap it up. Let's just finish in fixed income. How selective are you being? Where in fixed income? What pockets do you like? What don't you like?
Yeah, very clear in public markets, you're not getting paid in high yield what I would want to get paid to take that risk. So you can be more conservative. I mean, we work with a lot of US investors, munis, investment grade on the public side. You're still making that mid-single digit return. That makes sense. I mentioned bank preferreds, again, selectively. You can get even better returns tax equivalent. And then, of course, on the private side, there are opportunities in private credit, but we know lending is going to be tougher, and you're going to see some credit constraints moving into the back half of the year and next year. So again, it's about being selective. Although in private credit, you can get those double-digit returns by looking at the right kind of investments. And we just focus on making sure you're looking at companies that have reasonable leverage and a good runway for growth.
Monica, thanks for the update, as always. Monica DeCenso on the latest there from JP Morgan. The outlook, pretty decent, and hoping for more of the same through next year. Right to be constructive so far, and that's hard to push back against given the gains we've had year to date. To start things off in August, about 13 minutes into August and this session, we are negative by 0.2% on the S&P 500. On the NASDAQ, we're negative by 0.44%. Coming up next, Governor DeSantis outlining his economic plan.
We are today declaring our economic independence from the failed elites and policies that have harmed this nation's middle class.
What did that remind you of? That conversation up next.
Season is here.
Decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it.
They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust. This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's for the Fed to respond to it. And this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy, but man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Now it's time for the American people to take back their future. We're going to take it back. We have become more dependent on foreign countries than ever before. Ladies and gentlemen, it's time to declare our economic independence once again.
It is time to declare our economic independence once again. Former President Donald Trump running the base back in 2016. 7 years later, Governor DeSantis unveiling his very own Declaration of Economic Independence.
We are today declaring our economic independence from the failed elites and policies that have harmed this nation's middle class. We will declare our economic independence from the failed elites that have orchestrated American decline, from the reckless federal spending that has inflated prices and plunged this nation to the brink of bankruptcy. We will declare our economic independence from the Chinese Communist Party.
Governor DeSantis challenging trade relations with China and taking game at the Federal Reserve.
We need to rein in the Federal Reserve. It is not designed or supposed to be an economic central planner. It is not supposed to be indulging in social justice or social engineering. It's got one job: maintain stable prices. And it has departed from that with what it's done over the last many years.
Joining us now down in Washington is Bloomberg's Anne-Marie. Anne-Marie, that didn't go unnoticed by the former president, did it? Declaration of Economic Independence.
No, it certainly didn't, but clearly the Florida government is taking a playbook out of another Florida man, Trump. If it worked for him in 2016, I guess the DeSantis camp thinks, could it work for Governor Ron DeSantis for 2024? But what we do see, Jonathan, from the DeSantis camp, which Trump is just crushing in the polls, really across the entire Republican stage, is we see a broader pivot to talk about more than just going after quote-unquote woke corporations. He's talking about everything from China, from taxes, energy independence, student loan debt relief. So this is a really broad economic plan, and it shows that DeSantis is trying to look beyond just his playbook in Florida and what works for Florida maybe could work for the rest of America, and really try to reach to a broader spectrum of Americas. So what you see here in a lot of these policies is the typical conservative Republican policies when it comes to the economy, but also when he talks about China and a tough stance and a harsher stance on China, that is really invoking a lot of populism that we have seen over the past 5 to 10 years from the Republican Party.
When he says we win, they lose, who is we and who are they?
That's a great question. You know, Jonathan, your production team and I were debating this. When Ron DeSantis says we win, they lose, he's really going after everyone. Democrats, bureaucrats, the elite, because he says that we need to get policies that help working class families, and of course, Beijing.
Anne-Marie, on the latest down in Washington. Looking forward to Balance of Power a little bit later. Catch up on that program at 5 p.m. Eastern Time. Let's get you up to speed on some of the economic data out moments ago. Katie Lyons has more. Hey, Katie.
Hey, John, we got the final July read on the U.S. S&P Global Manufacturing PMI. It matched the prior read at 49. So for a third month in a row, manufacturing remains in contraction territory, though that contraction is happening at a slower pace. Remember, the June read was 46.3. So this is an improvement. Still, though, new export orders fell for the 14-month running. Firms also reported, interestingly, a renewed rise in material costs, raw material costs, input prices faced by manufacturers increasing for the first time in 3 months. So an interesting inflationary read there. But on the employment read, especially, John, as we look forward to the data later this morning and throughout the week, culminating in the jobs report on Friday, companies did expand employment at a faster rate with greater confidence in the outlook going forward. So we remain in contraction in the manufacturing sector, John, but they maybe see a brighter future, and that would read through to the labor market in theory.
Katie, thank you. That's the final read of the S&P Global Manufacturing PMI. We get the ISM at the top of the hour, the ISM manufacturing number. Looking for that to come in at 46.9. 46.9. That is the number in our survey right now. Looking forward beyond that, jolts as well coming up in about 8 minutes' time. Beyond that, go to payrolls. Katie mentioned payrolls. The estimate at the moment in our survey, still 200,000 for the headline jobs growth number for payrolls. For unemployment, about 3.6%. 0.5%. Let's get you some sector price action. We can do that with Abby.
Hey, John. Well, we do have a small decline for the S&P 500. Not surprisingly, most sectors are lower. One that is higher, industrials up 0.3%, helped out by Caterpillar. It's interesting that we're having this manufacturing weakness, given the strength for at least one of the industrial companies, Caterpillar. Most of the other sectors, though, you can see down. Discretionary and communication services, two of those mega cap tech sectors. Well, they are both down about 0.5% or so to start out the month of August. Now, going back to July, you were mentioning earlier, China tech up 20%, its best month since November of last year. But today, a little bit of a cooling here. The Golden Dragon China Index down 1.4%, and lots of the big players taking a break to probably a consolidation of those big games, John.
Abby, a little bit lower this morning. Abby, thank you. We're down by, let's call it 0.2% on the S&P. Your trading diary is up next.
What do you worry most about your economy in Greece? And when you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, in 5 years from now, we will not have sacrificed, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
This is Bloomberg.
The outperformance last month in July came from the Russell, up 6%. This morning, it's where the underperformance comes from. The Russell is negative by 0.75%. The S&P 500 a little lighter. We're down here by 0.2%. That's the price action. Here's the trading diary. Coming up, the JOLTS report and ISM manufacturing numbers at the top of the hour. Qualcomm earnings on Wednesday, followed by Apple and Amazon results on Thursday. Plus, we get a Bank of England rate decision on Thursday as well. Another round of jobless claims too, and durable goods orders. And finally, on Friday, the payrolls report. The payrolls report, and what I think is the best lineup on payrolls day in America, anywhere on the planet. Rick Reeder of BlackRock, Anastasia Amoroso of iCapital, Mike Collins of PGIM, Mohammed Al-Aaron of Queen's College, Cambridge, and so much more. All of that coming up on Friday. Just a few more days to go. From New York City, that does it for me. Thank you for choosing Bloomberg TV. This was the Countdown to the Open. This is Bloomberg.
everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about, like, how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Was going to keep rain World Cup. This is a 3
as the economic picture does.
The OK is getting ready to make a decision.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City. To our worldwide audience, red and green on the screen. We'll break it down going forward. I got a 10-year Treasury yielding 4%. We'll check in with Ira Jersey, Chief U.S. Interest Rate Strategist, to get his sense of where this rates are going. Plus Stephanie Pierce at BNY Mellon. We're going to talk ETFs with Stephanie. And then a fascinating, we're going to do a simulcast with the PJT Partners CEO, Paul Taubman. He is one of the top M&A bankers on Wall Street. He's going to sit down with Shonali Basak, our Wall Street reporter, to talk about the state of the M&A biz in the marketplace right now. But first, let's kick it all off with Mr. John Tucker in the Bloomberg Business Flash.
All right, top of the hour data dump, the JOLTS job opening survey. I'm going to say right out of the gate, this is kind of Fed friendly. So we had fewer job openings than we had the previous month, 9,582,000 for the month of June. That, again, less than the previous period and also less than the expectations. Also, manufacturing. Now, this is ISM Manufacturing Index coming in at 46.4. So that is a little better than we saw the previous month. The expectation was for 46.9, below expectations, better than the previous month. The prices paid component of that is coming in greater than the previous, but lower than expectations. So put that all into your bag, mix it up. You get the S&P 500 right now 6 points lower. That's down 0.1%. More importantly, the more reactive 2-year yield, right now it's unchanged at 4.88. Among the earnings, JetBlue slashing its full-year profit forecast. Pfizer reducing its sales outlook. Cameron Dawson at New Edge Wealth says, at the end of the day, what matters is just how much companies are earning.
Momentum can propel us in the short term, but I think the challenge we have is that valuations are still very high, which just means that earnings do have to deliver, and we likely need to see earnings revisions continue to move higher instead of the recent downward revisions that we've seen come out of this earnings cycle.
Right now, the NASDAQ 100, 69 points lower. That is down 0.4%. Dow Jones Industrial Average is up 102 points. That's a rise of 0.3%. And again, the S&P 500 lower just by 7 points right now, a decline of about 0.2%. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Jess and Paul.
All right, John Tucker, thank you so much. We appreciate it. Jess Metten sitting in this morning. Good morning, Jess.
Good morning. Great to be here on this Tuesday. John Tucker, not in a blazer, unfortunately, but there's two other gentlemen here. I think it's great, though.
You just called me a slob.
No, I didn't. I was saying that Paul, the fashion police sweetie, is here. But hey, I'm not wearing one either. It's hot out there. I don't want to wear a blazer today.
I mean, John's a grizzled newsroom guy. I mean,
he is. I love it, and he's got the Bloomberg jacket on. That's what counts.
I gave up the jacket. For 25 years, jacket and tie. After the pandemic, I just
lost it.
No need for that now.
All right, it's the new world order. At least he comes into the office, which is a plus relative to most
Paul's
people.
very bullish about in office.
Exactly. All right, Jess Metten and Paul Sweeney here in the Bloomberg Interactive Broker Studio. We're streaming live on YouTube. You can head over to that internet thing and search Bloomberg Global News. It's John just reporting a little red, a little green on the screen, a little bit lack of direction here. But let's check and see what's happening under the hood. We can do that with Bloomberg's markets reporter, Bailey Lipschultz. Bailey, what are you looking at?
Yeah, a lot of earnings here. Earnings season is in full steam. Looking at some of the worst performers after results, Norwegian Cruise down 13%. This coming after underwhelming results. And another stock that's in the red pretty sharply lower is Molson Coors, so beer maker down more than 5%. Kind of a bit of a surprise, according to analysts who are expecting the company to really benefit from that backlash against competitor Bud Light, but it does not seem to be coming to fruition. Some of the leaders to the upside, though, Caterpillar, all-time high, as you mentioned at the top, Paul, up more than 6.5%. So slow down fears, be darned. Profit topping expectations, management talking up how they feel about the backlog. So really seeing a bit of a mixed earnings day in particular. Again, you've got JetBlue down after a profit warning. You've got Uber dropping lower, even though it seemed like it was going to open in the green after swinging to a surprise profit. One thing that a couple analysts have been flagging, delivery segment somewhat soft. So a lot to chew on, a lot of company results, and you've got an S&P down 0.1%. So no gas. Yep.
Bailey, one of our star reporters, as we know, on our U.S. equities team, but also covers what's happening in the IPO market, ECM, but Shark Ninja leaping yesterday on its first trading session as a standalone company.
We had the CEO on yesterday.
Yeah. So tell us more about what you've been finding in your columns here.
Yeah, no, I mean, when you look at Shark Ninja, so this is a company that was spun out.
Never heard of it before.
Really?
Never heard of the product.
Really?
Shark Ninja? Yes. I own all of it. I got a Shark vacuum. I got a Ninja coffee maker.
What are those grills?
I do not. I mean, apartment size. Actually, you could probably have them in the apartment. I know they have pressure cookers.
Yeah.
It's all the rage.
Never heard of it until I talked to this guy yesterday.
I've
never been to a Sweetgreen until I talked to the CEO of Sweetgreen yesterday. So yesterday was a day of first.
What about
we
Kava?
call this a generation gap.
Yes.
I thought we all were going to go to Kava at some point.
Yeah, we need to do that.
No, I still haven't been. I mean, but again, this is a company that was parent company based in Hong Kong, spinning off an appliance maker, talking up growth. They are profitable. So yesterday they opened at $30, closed at 42, so about a 41% rise, down 12% today, only 200,000 shares traded. Interesting thing is that if you're an owner of the parent company, for every 25 shares of that, you got 1 share of Shark Ninja. So it seems like it'll be, like with most spinoffs, a few days, maybe a few weeks where you get the volume really to shake out where the stock can really get its place, because again, right now it's down 13%, but all things considered, very light volume for a new stock.
JetBlue, profit warning fuels concern over U.S. travel demand. So I put that together with the Norwegian Cruise Line. I mean, is that kind of revenge kind of travel? Is that kind of playing out, is what we're seeing?
It seems almost like there was so much optimism and we saw such a burst in spending in the summer that now, whether it's the companies being more cautious or the street getting ahead of itself, like TD Cowen called the guidance for JetBlue extremely disappointing.
Okay.
So you're looking at an industry that has been red hot, has been among the best performers alongside some of those AI names, and now maybe they got a bit over their skis in terms of talking up expectations. One thing to consider, I mean, JetBlue's now only up 12% this year, and you compare that with a company like Norwegian Cruise, which is up more than 55%. So selling a bit of the big winners so far this year, but it does seem like that post-pandemic craving for air travel, for flights, for experiences, maybe drying up just a touch again into the back half of the year where analysts are looking for, and especially into 2024 right now.
And Paul and I have talked to a lot of Bloomberg intelligence analysts where they've pointed out more so when it comes to the domestic travel, just not being there compared to when you're looking more internationally. So it's interesting looking at the divergence when you're seeing Delta and their profit outlook in the summer travel season versus some of these other ones like JetBlue.
Yeah, and even more to break that down, you look at a stock like Southwest, which my family is big Southwest fans. I can't get to California without 4 different connecting flights. And so when you look at how these companies are exposed, as you mentioned, Jess, we are seeing and have been hearing a lot about demand for European travel, and that's something that a lot of these companies have been talking up. But as you mentioned, slower demand for domestic travel, and obviously we saw a number of traffic issues. I was part of it around the 4th of July holiday, so a lot of these airlines are also maybe getting dinged, and that could be weighing into their outlook for the third quarter this year.
Again, my flying policy, I only fly when someone pays me to fly. Because the airport people, they have no idea what's going on. They're overwhelmed. The airlines are overwhelmed. I'm not getting caught up in that mess. So I'm waiting for it. Now, the cruise thing, that kind of took me by surprise because I thought there'd just be years and years of bookings. But maybe we're a couple years kind of post-pandemic here. And if you've taken your cruise and you're not someone like Charlie Pellet who cruises, every other month, it seems like he's cruising somewhere around the world. So,
well, I mean, you look at Norwegian, they hiked their full year earnings guidance by 5 cents to 80 cents a share. So this, I would say, if you're going to break down the two, they're slightly different in the sense that when your stock was up more than 80% so far this year, the bar just continues to get higher, and you have to continue to blow out. I mean, you look at Royal Caribbean, they had terrific results last week.
Yeah.
So I don't know, was Norwegian kicking themselves when they saw Royal Caribbean's results? Maybe, but.
All right, Bailey, good stuff. Thanks for bringing us up to date on what's happening out there. Again, another big earnings day. We've got some eco data as well. Bailey Lipschultz, he covers all the markets for us. Let's switch gears and go to our Federal Reserve. It is Tuesday. We like to talk to Ira Jersey. He's the chief U.S. interest rate strategist for Bloomberg Intelligence. And Ira, we got some economic data today. I mean, ISM manufacturing still below 50, still contracting. It's better than last month. So the economy is, trying to keep kind of chugging along here. How do you think the Fed kind of views the overall economy here?
Yeah, I think the Federal Reserve is actually pretty happy with the economy. Their concern is inflation too high? And will the data today with manufacturing maybe not as bad as it has been in recent months, will that mean that prices are going to go up? And interestingly, in that ISM data that we got just a couple of minutes ago, Paul, showed that prices paid was lower. So actually the inflation component of the ISM manufacturing survey suggested goods prices might continue to come down. But this week, Paul, most importantly, obviously, is payrolls. But second to that, in my book, in the way that I am analyzing the economy right now, is going to be Thursday's ISM services report. So looking at prices paid in there, as well as new orders, and what's going on with some of the forward-looking components of those data.
And Ira, looking at Treasuries pairing some of those losses on the ISM, but then also the JOLTS jobs opening data, seeing that as far as those openings just dropping slightly and the quits rate ticking down in June in that data, and looking over at what the 10-year is yielding, close to around 4%. What's your view on the direction of the 10-year, and where does Bloomberg Intelligence forecast to see it at year end?
Yeah, so we just revised our forecast this morning, actually, and so we do think that 10-year yields are going to be lower than where they are now. I think currently the market's in a range, and there's a couple of technical things going on as well. So firstly, we saw today's move, the move about 5 basis points higher in 10-year yields, was driven largely by what's going on in Europe and the hawkish or hawkish expectations out of Europe and the Bank of England in particular. But importantly, tomorrow morning at 8:30, we have the Treasury refunding announcement, and the Treasury Department will be increasing the size and the supply of treasuries coming to market. So I think some people are adjusting to that possibility and just thinking, hey, if there's more supply, maybe it'll be harder for market participants to digest the larger issuance sizes. And so I think the market's adjusting to that. But by the end of the year, Anna Wong in Bloomberg Economics believes that there'll be a recession. If there is a recession, you could expect 10-year Treasury yields to rally about 70 basis points or so from current levels. And so our year-end forecast is 3.32%, if you want to be very precise.
So, Ira, when the government comes to refund their debt, which I know they're going to do here, I guess, in the next several days here, they got to raise a lot of money because the deficit keeps growing. Interest rates are higher, so the refinance, it becomes even more expensive. I mean, do we run the risk of having not failed auctions, but just disappointing auctions, which really causes some concern in the marketplace?
Yeah, I think we do. What happened in 2022, we had some very weak auctions, and even earlier this year, particularly when a lot of people thought maybe yields weren't high enough. The Federal Reserve was continuing to hike interest rates pretty aggressively. Now that it looks like the Federal Reserve is nearing or at the end of their hiking cycle, some of the auctions more recently in the last 2 months have actually been reasonably well received. I'd say that the auctions are somewhat more mixed. But yeah, there is, to your point, Paul, I think a real risk that if the government raises the size of some of these auctions too far, too fast, that it may be, again, difficult to digest. So some of the things you want to look at when we get to some of the auctions next week is what's the bid to cover doing? So how many bids, how many offers are there to buy bonds are there compared to the amount on offer? And then secondly, your indirect bidders. So these are investors, end users, central banks, pension funds, mutual funds, who all bid through third parties. And if they come in strong, that means that end user demand is really good. Obviously, the converse is true as well. If those are relatively low compared to recent history, then you could expect there to be, maybe yields go a little bit higher because of the lack of demand.
Ira, explain to us what's going on when we're looking at how speculators were more bearish on Treasury futures in this latest data that came obviously ahead of the Fed's just prior meeting that we just had, and what's happening as far as how they're boosting their net short exposure across this curve, with the exception if you're looking at, say, 5- and 10-year futures.
Yeah, it's a little bit difficult to tell. When a hedge fund or levered investor, and that's a prime. So there's speculators, right? So we had no speculators versus hedgers. That's one component. But then there's another breakdown that's levered investors versus asset managers versus dealers. And when you look, it's almost all levered funds that are short. So the question is, are they short treasuries because on the other side they happen to be long corporates or long equities? Like, is that a hedge to other assets that they might have a position in? And so it's a little bit difficult to know that. I do suspect that there are people who just had taken advantage of the fact that we had rallied back to, it wasn't that long ago that we were at 3.5% in treasuries. So now we've sold off to 4%. So there could be some short covering that we see somewhere around the old yield highs around 4.09%. That's a pretty important technical level at this point, and I suspect that as we get a little bit above 4%, you will see some short covering among those levered investors.
Ira, talk to us about liquidity in the marketplace. If I'm a big mutual fund or hedge fund and I want to dump a bunch of treasuries, I call up Morgan Stanley and Goldman Sachs and I say, hey, bid me here. What kind of efficiency, what kind of execution am I going to get?
Yeah, there's been these pockets of illiquidity that have cropped up. Liquidity over the last couple of weeks has actually been pretty decent. You've seen decent sizes in terms of on the screens of what you're able to sell. I think that the challenge for market participants is everyone going the same way all at once. And we haven't seen that so much the last month or so, but you did see earlier this year when there were a lot of people rushing to buy securities, for example, in March during the SVB, the banking angst that was going on. You saw these pockets of illiquidity where no one wanted to sell their treasuries because everyone thought the price was going to be higher. So you saw these big jumps in price and much lower yields very quickly. quickly. So I call the liquidity at this point as being fickle. So it's like liquidity is really good until it's not, and then when it's not, it's really not good.
Right. All right. Ira Jersey, thank you so much. We appreciate it. As always, getting our lowdown on what our Federal Reserve is going to do in the Treasury market. Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence. And Jess, I can go park, some money in a 2-year Treasury and get 4.9% with no risk. That's not bad.
And also money market funds, right?
Yep.
I mean, clearly, if you look at the latest data and some of the inflows that were happening there, investors still picking that up when you're looking at what you can yield in that space.
Yeah, not bad. So, maybe Tom Keene and his triple all leverage cash fund,
Right.
maybe clipping some coupons here. S&P 500 off 0.3%. The Dow up slightly. We'll have more coming up. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Paul, shares of Uber are down more than 4.5%, and that's despite the company reporting its first ever operating profit, fueled by demand for rides and deliveries. More on that from Bloomberg's Charlie Pellet.
Steve, it marks a significant milestone as the company seeks to move beyond its cash-burning past. The results show that trips in both the U.S. and Canada have recovered to pre-pandemic levels, while delivery demand hit a record despite increased costs for food. Uber's business has remained largely unscathed from elevated inflation rates, as customers are still willing to pay a premium for the convenience of hailing a ride and getting food delivered to their door. Steve?
Thanks, Charlie. HSBC announces a new buyback program as higher interest rates boosted profit in the second quarter. The London-based lender also said it now expects net interest income for the year to be above $35 billion, up from more than $34 billion. CEO Noel Quinn tells Bloomberg he's pleased with the bank's performance.
I think that those results are a function of good revenue growth across the globe. All of our global businesses had strong revenue growth. All of the product lines within those businesses, strong revenue growth. But also all geographies contributed to that performance.
Quinn on a media call earlier stressed HSBC's wealth business continues to gather momentum, particularly in Asia. And CVS plans to cut 5,000 positions from its workforce to help reduce costs as the drugstore chain moves deeper into patient care services. A spokesperson says the job losses will not impact customer-facing positions in stores. Shares of CVS currently little changed. Those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
Connection lost.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. The economic data this morning, evidence of softness in the labor market. Job openings falling in June to the lowest level since April of 2021. The Labor Department's JOLTS survey showing the number of available positions eased to 9.6 million. And then you had the ISM Prices Paid Index that was lower than expected. Both, I'm going to say, are Fed-friendly. Stocks right now, they are mixed, the major averages. The Dow, it is higher by 15 points, and shares of Caterpillar doing the heavy lifting there after their earnings report. Amazon and Apple are both lower ahead of their earnings this week. That's going to be on Thursday. That right now is weighing on the S&P 500 and the NASDAQ 100. S&P 500, 18 points lower. The NASDAQ 100 is down 97 points. And it's back. Overstock officially relaunching the Bed Bath & Beyond domain online in the U.S. They acquired the bankrupt retailer's intellectual property for, what, $21.5 million last month.
Bed Bath & Beyond, originally based in Union, New Jersey.
And outrageously expensive. But that's just one person's opinion.
That's just one, yeah, because you're such an avid shopper at Bed Bath & Beyond, I'm sure. John's in there looking at shower curtains.
When I have to. And that is your Bloomberg Business Flash, Jess and Paul.
All right, John Tucker, thank you so much. We appreciate it. Jess Met and Paul Sweeney here in the Bloomberg Interactive Broker Studio. We are streaming on YouTube. Just head over to YouTube and search Bloomberg Global News. All right, here are some ETF stats for you that just blow you away. At the end of 2022, ETFs made up 28% of all fund assets. That's up from 7% 5 years prior. And in 2022, mutual funds net outflows were over $1 trillion. ETF net inflows, almost $600 billion. So just the amount of money and how it's changing hands and how the asset management business is changing is just amazing. And what little I know about the ETF business, I've learned from our next guest, Stephanie Pierce, CEO at Dreyfus, Mellon, and Exchange Traded Funds at BNY Mellon, the worst title of all time, all that kind of stuff going on. I have to work on that. So, Stephanie, thanks for joining us here in our Bloomberg Interactive Broker Studio. I mean, those stats are just amazing. If I'm sitting at Fidelity or any of these other, T. Rowe Price,
or BNY Mellon.
What do you do? I mean, the ETF business that you're running, it's the trends are just amazing.
It is unbelievable. So ETFs reached $7.3 trillion of assets at the end of the second quarter here in the United States. And as you said, we see a like amount of inflows into ETFs and almost a like amount of outflows out of mutual funds. So this year alone, $212 billion into ETFs, $180 billion out of mutual funds. But really where the action is active ETFs. Okay. So active ETFs, what we like to say, are punching above their weight. They are 6% of the overall industry, so we're still 94% passive. But this year, active ETFs are 22% of net flows. So it's a really exciting story, and if you don't mind, I might have to share a few sniglets on that.
Yes, please. Because my thing is, I thought ETFs by definition were passive, and therefore I don't pay any fee or very low fee. But when you put the word active in there, I'm like, uh-oh, I got a manager, I got some analysts, I got some research, I got to pay for all that stuff.
That's right, and I think what we see is clients are voting with their feet. So just yesterday, we had a really exciting day. We rang the closing bell at the NASDAQ for the two launches of our thematic ETFs, BKIV and BKWO, which are Innovators ETF and our Women's Opportunities ETF, respectively. And it was incredibly exciting. These are both managed by our active equity team at Newton Investment Management, one of the affiliates of BNY Mellon. And we've been doing thematic investing for over 20 years. So it's incredibly exciting. And we had a lot of fun, friends and family and guests with us to ring the bell.
Cool, it's always fun.
Can I share
just
a couple of sniglets as to so what and why should you care? Especially for you, Paul.
You bet.
So for innovators, I think many of you may know this, right? But the companies that transform the way we live and work and play today are not the companies we knew of yore, right? If you think about it, when my parents were growing up in the 1950s, the S&P 500 average lifespan of a company was 61 years. Anyone want to guess what that is today?
I'm guessing shorter.
21 years.
There you go.
And about 15 years ago, the 52% of the S&P 500, of the Fortune 500 companies that we knew today, they're no longer here.
Okay.
Right? So we're seeing companies created and disappearing at an alarming and rapid rate.
I didn't know that. Okay.
And so this portfolio is all about that next generation of companies that are transforming the way we live, the way we work, the way we play. And we believe that that creates jobs, productivity, it enhances the way we live our lives globally. And we want to give clients a platform to invest in those companies right now, and that's what BKIV seeks to do.
So what are the flows telling us at this point?
Well, again, we like to say the flows are telling us that clients prefer this vehicle for tax reasons, for cost reasons, for transparency reasons. I like to say that ETFs are the ultimate democratization of finance, right?
Okay.
There's one price no matter how much you have to spend, right? There's they trade all day long. You can see all the holdings. There's no hiding, right? You could buy it anywhere. It's a mutual fund that trades like a stock. That's what I tell my 13-year-old daughter. Probably doesn't know even what that means. But it's very easy to understand. And you can buy it anywhere. So it levels the playing field for those who have and those who have not. And that's why you're seeing the flows that you're seeing into ETFs and out of other vehicles.
It's interesting because the growth-related flows, if you're looking at, say, Lipper data earlier this year coming into the first half, we were seeing these outflows, but then it was coming at the same time, you're looking at especially these big tech stocks carrying this rally. So are we going to continue to see that type of divergence there and stocks still even close to these records again, even though we see some of these outflows in the growth area?
Look, hard to know. I mean, I always joke about, the view that anyone has on the markets is probably worth the price of a cup of coffee. Could go up, could go down. But one thing we do know is clients need advice more than ever. And as I think some of you know, we've been very focused on how we enable our advisors in our Pershing business and our broader business to deliver client advice more successfully. There's a statistic out there which we believe to be true, which is that 75% of the time that investment advisors spend is actually on administrative tasks and only 25% serving their clients. So with the launch of our Pershing X Wove platform, our goal is to flip that equation. And as I think, Paul, you know, since we launched that at Insight, it's been to rave reviews because advisors realize that what they really want to do is spend time with their clients, and they're doing anything but that. So we've created a holistic and what we think will be transformational platform that has your technology tools, your investment solutions, everything all in one place for clients. In my business, behind the curtain of Wove, we're actually offering our direct indexing capability, BNY Mellon Precision Direct Indexing, as part of that package or that platform, making it really easy for advisors to deliver real value to clients. So we're really excited about that piece of our business.
For the active ETF business, since it is such a big growth in the industry, what's on average kind of the cost to the investor of an active ETF versus, say, a mutual fund?
Sure. I mean, it's really not that different, the active versus the active. The big difference is
the active versus the passive?
The active versus active. So active fund versus active ETF. The big difference is, certainly the transparency, the accessibility, the ability to have a single share class, no share classes, just a single price for everybody, no matter how big or small your assets are, and the access to it all day long, right? You can just buy it and sell it all day long. So that's really the big difference, Paul. The other thing I would just say, talking about kind of leveling the playing field, the other ETF that we launched, that we celebrated last night with the closing bell at the NASDAQ was BKWO, which is our Women's Opportunity ETF. And I have to say, as a executive here in this industry for 30 years, I couldn't be more proud to be doing this. The thesis here is pretty straightforward, right? Companies that do the right things in terms of recruiting, retaining, promoting, and empowering women actually tend to outperform companies that don't. And so we have two female portfolio managers, all also out of Newton, that are running this fund. And again, super exciting. We are partnering with Girls Inc., which you may know has a big chapter in New York City. So they were at the bell ringing with us. We're giving a contribution of 10% of our revenue on this fund to fund the programs of Girls Inc. to empower the next generation of girls in leadership roles. So just couldn't be more excited for what we're doing, both for our clients and for the next generation.
That's definitely great stuff. Something I'm curious about, because Paul and I discuss what's happening with money market mutual funds so often, and when it correlates to obviously what's happening in the yield space, what are you seeing with the flows there? And at what point will we begin to see more of an excessive outflows to where maybe that's more geared toward that money going toward U.S. stocks?
Sure. I mean, we have definitely seen a wall of cash as we like to say, cash has become sexy again, right? So I do run the Dreyfus business, which is, a top 10 money fund player in the industry. We actually turn 50 next year. So we're really excited about that. And, with yields at, call it 5 now, a little over 5%, right? With the Fed move just recently, this is actually a really attractive place to be, and the hurdle rate to go into other asset classes is just a little bit higher, right? If this is effectively a lower risk asset. So we continue to see a lot of cash in money funds. But as you said, certainly with the environment that we're seeing, potential for a soft landing, a little bit more of hopefully approaching terminal rates here, certainly more money going out into the market and even into longer duration. Even we in our money market funds, as conservative as we are starting to extend duration here. So that's starting to happen.
So what's the catalyst, do you think, to have more of that money flow into U.S. stocks? Do you think it's more like you were talking about the soft landing sort of scenario?
I think so. I mean, what we tend to see is that equities don't really typically see through recession the way fixed income securities do, right? And so we've seen, if you look at just year to date, even in ETF land, right, a lot of that flow that I mentioned, that 212 billion, a big chunk of that is in fixed income where people are starting to extend duration. So you're starting to see that in fixed income in the next